Okay, let's now move to our next topic, which is on portfolio management. First, I'll give broad overview. We discuss concept. Along with that, we'll do the problem. Now, portfolio management has multiple items. Like first, you need to understand how to calculate risk and return of an individual security. Then we move to risk and return of a portfolio. When you do that, there are interrelated elements called correlation coefficient and covariance. Then I move to something called as efficient, inefficient security, beta of a security, beta of portfolio. How do I alter the portfolio? So multiple elements are there. We'll go each one by one. The starting part is very simple. First thing I need to know is in this chapter, my focus is only two elements. If I get these two properly, everything else is formality. I can keep doing any type of a question. So first I'll discuss those two items which I need. Once I get those two items, I'll create a format in Excel. I'll do question 1 together. Question 2, I'll just change the numbers. Automatically the format will give the answer. So our objective is to somehow get clarity on those two elements. The two elements I need is return and probability. Return and probability. I technically don't need anything beyond this. The chapter revolves around multiple formats, multiple formulae. Do I need to remember formula? Yes, few places I may tell you to remember, but major chunk I don't expect you to even remember the formula. It will revolve around 2-3 formats. If you're clear on the formats, things will automatically fall. The first format we are going to use is return, probability. When you multiply them together, return and probability, we call it as product. And then there is a deviation and there is a PD square. There's a deviation, there is a PD square. What is the purpose of this? Return into probability, the product total is called expected return. If somebody wants to know expected marks in CA exam, I will write marks, probability, do a weighted average of it. What marks I'm going to get, what is the probability? That's what we did in that first Chicago method. 3 different valuation, multiply with the probability. So return and probability is my starting part. In that, probability could be given in the question, or we assume equal probability and proceed. IC has different approaches, but I don't want to get into multiple approaches. Make it very simple. We will assume equal probability except at one place, which is called beta computation. I'll explain that there. That's why in the overview, there's a beta of security without probability and then with probability. Now, how do I compute return? NAV1 minus NAV0 plus D1 plus CG1 divided by NAV0 into 100. Whether it may look very simple, but major chunk of the student make mistake in calculating return. Once your return is wrong, there's nothing else needs to be done in the question, because if you're writing the wrong return, I don't have anything else to do in the problem because you've started with a mistake. The first column itself is error. Return, probability, product. What is deviation? How much is the deviation in performance from the average? What is the use of it? To calculate standard deviation, So let's first focus on return. Return is equal to P1 minus P0 plus P1 plus D1 divided by P0 into 100. This is the first formula. Few question what they will do is, instead of giving dividend, they'll give dividend yield. What is dividend yield is? It's a percentage where, not dividend rate, I'm talking about dividend yield. If dividend yield is given in the question, it's already in percentage. So what you need to do is P1 minus P0 divided by P0 get 1%, which is called capital appreciation, and add the dividend yield. Or what you can do, you can use the dividend yield, multiply with the price and get the dividend and apply the same formula. So if it's in percentage, leave the percentage aside, dividend yield, not dividend rate. Dividend rate is on face value, dividend yield is on market price. If the return is given for multiple scenario or years, we are first trying to calculate how to compute return. So first formula is P1 minus P0 divided by P0 plus D1 into 100. Assume I have return for multiple years. What is the final return? Simple average of this. If probability is there, weighted average multiplied with the probability. As such, even if probability is not given, we will assume equal probability. Now the question can go ahead and say that the price can be 100, 150, 200. The dividend can be 20, 10, 15. 3 different options they are giving. And they are giving probability for everything. In that scenario, price 20, dividend 10, one combination. Price 50, dividend 10, another combination. Price 100. So 3 into 3, 9 possible combinations are possible. If you give different prices and different dividend, for each of that, what you need to do? P1 minus P0 plus D1 divided by P0 into 100. You will have to apply the formula. So the focus is calculating the return, which I did in mutual fund. NAV1 minus NAV0 plus D1 plus CG1 divided by NAV0 into 100. May look very simple. You will see how mistakes are made in this area, because that is where the challenge is. Very simple question initial. You have purchased 5,000 shares of R Limited by paying 2 lakh. What is the purchase price? Tell me the purchase price. Price 40. This is my NAV0. This is the price I have paid. Closing price is how much? 50. So P1 minus P0. Dividend is 20% on face value. If it's dividend yield, directly add 20% in return. Directly add 20% in return. So I add 2, I get 30%. Clear? Any doubts on this? Now let's see how many of you are able to answer this. I want the answer for this. I want you to calculate return for this year. This is the data. Let's see how many of you get this. Give me the return for the present year.
216.7.
Okay, let others participate. I'm not sure on the answer. Let others do it. I don't want the answer. I don't want you to look at the answer also. Just tell me what minus what you are doing, or what are you doing in the formula. 197 minus 164.2. Okay. Okay. Plus 0. I'm not sure. You give it a try. Let me know. It's a very simple observation. Unless you get the return, nothing much can be done in the question. Without return calculation, I cannot do anything in the problem. So if you are not able to give me return, we are stuck. Okay, now listen. Many a times what happens is data is given like this: 1, 2, 3, 4, 5 futuristic data. This is in the reverse order. This is in the reverse order. So this is closing price. This is opening price. The closing price is 197.2. The opening price is 164.2. The closing price is 197.2. The opening price, or what I can do is, this is 2022. This is 23. This is 24. Return of 24 is equal to price of 24 minus price of 23 divided by price of 23 plus the dividend yield of 24 plus the dividend yield of 24. So 197 minus 164.2 divided by 164.2 plus 10% directly, plus 10% directly. Any doubts on this? Any doubts on this? The order in which they have given it is reverse. What you normally see is like this. Okay, this whatever you did is I picked it from here. This is how you normally see first year price, second year price, third year price, fourth year price. So there it becomes slightly easier for us to do, because closing price is this minus the previous is the opening price divided by the opening price, add the dividend which is there, and then you can kind of be done. But if it is given in the reverse order, sometimes students make a mistake. So that was that example which I showed. Net to cut it short, unless you calculate right return, I cannot do anything in the question. So first thing is calculating return properly, for which I have only simple formula: P1 minus P0 divided by P0 plus D1 you can do, or plus DY you can do. DY is dividend yield in percentage. Any doubts till this? Any doubts on this? Okay, assuming you are able to calculate the return properly. If you're able to calculate the return properly, we'll do questions on this in some time. If you're able to do return properly, This is our format one, which you need to remember. When I say remember, basically I'll be using this extensively. Return, probability, product, deviation, PD square. If you write return and probability correctly, then technically unless you do a calculation error, you cannot make a mistake. Unless you do a calculation error, you cannot make a mistake. So logically speaking, moment I write return and probability correctly, problem is over. Because balances in Excel, I'll just put a formula and automatically the answer will come. In Excel, the automatic answer is going to come. Obviously in your calculator also it's automatic answer, but calculation errors happen. So initial question will do the entire setup, but after that my focus will be getting the return. You give me the return, I'll put the number, automatically the answer will come. Automatically the answer is going to come. So the first format is return, probability, product, deviation, PD square. Product, deviation and PD square. What is probability? Equal probability are given in the question. What is return? As per concept 1. As per concept 1. What is product? Return into probability. What is deviation? This column, return column, minus the sum of the product. PD square is probability into deviation. Square is only for deviation. Put a total, take a square root, you will get the standard deviation. Example, compute the standard deviation of security from the following information. I don't want you to do anything as of now. Basics, let's just set it up. Then when we do comprehensive question, you will do along with me. So I need return, probability, product, deviation, PD square. Return and probability is given in the question, which is 10, 20, minus 10, minus 20. Probability. So technically there cannot be a, when I say technically this doesn't test anything of yours. It just tests whether you know the format and whether you know the formula or not. Because return calculation is where the major challenge should come automatically. So what is product? Is multiplication. So beyond this, it's only calculators work. You are not going to do anything. Technically, you are not going to do anything. Return into probability, you get the product. We'll do questions on this as we proceed. Sum of product is, this is called return of security, which is 2%. Return of security is 2%. What is deviation? The first column, or it could be the second column, probability, return probability, that's okay. Return minus the sum. So 10 minus 2 is 20 minus 2, minus 10 minus 2, minus 20 minus 2, minus 22. Probability into deviation into deviation. Why we square the deviation is, deviation on the negative side or on the positive side, both are problem. I don't want any deviation. So moment I square it, negative becomes positive. So be it on the downside, be it on the upside, both are problem for me. So I square it and then take a square root. Total is 216. I'll take a square root of this. 14.69. Now any problem we are going to do, I'll just change the numbers, automatically things will be taken care of. One or two questions we will do the detailed calculation, but balance is what your calculators work. It is more of calculators work rather than you trying to do anything there. You are not doing anything. Issues, you make calculation errors. Issues, the calculation errors which are made. Any doubts till this? Okay, now I'm going to use the third concept, which is related to something on portfolio. We have done individual security, one security we have done. Now comes the third concept. Now, whenever I'm trying to calculate a return, if you combine two securities together, 10 and 16, if you combine them together, return will be 12, 13, 14, somewhere in between. Two securities, risk is 10 and 16. Weighted average may turn out to be 7, 6, 5, 4, 3. It can be any number. Normally, return is weighted average. Risk is not weighted average. Reason is, company A is doing excellent business in summer, but doing very bad in winter. So as such, you say it is a very risky company because does good sometimes, does bad sometimes. Monsoons, if summer is there, hot summers are there, this business will do excellent. Next year, summers are not there, a lot of winters is there, this business will do bad. Second business, opposite, does excellent in winters, does very bad in summer. On a standalone basis, very bad business. This is also very bad. But what you did, you combine them together. You combine them together and made a portfolio. Summer, one does bad, other does good. Winter, one does bad, other does good. So it kind of offsets. On an average, when you are looking at the performance, you find that your performance is not deviating much. One business is kind of offsetting the risk of the other business. That is called diversification. That is technically called diversification. Diversification is adding multiple businesses together which are negatively correlated. What is negatively correlated is one goes up, other goes down. One goes up, other goes down. So now for calculating the portfolio risk and return, I need an item called correlation coefficient and covariance, where nothing much needs to be done. Listen, same format. This is for one company. You have to do the same for another company. You have to do the same for another company where probability may become a common column. Where probability may become a common column. You don't need another probability column. You don't need another probability column. So I don't need another probability. So return, probability, product, deviation. Sorry, just give me a minute. Probability is taken outside. I have security 1, return, product, deviation, PD square. Security B, return, product, deviation, PD square. Now, deviation numbers you are going to present here. Let's take some numbers itself. 0.25, probability I am taking. Return is 10, 15, 20, 25. It is continuously going up. What is happening in this side is, when it is going up, this is the opposite. 30, 25, 20, 15. Mostly it's a negative correlation. When one goes up, other goes down. When other goes up, the other one is going down. Now first let's do individual security. What is individual security? Return into probability. You put a total. You do a deviation. You do a PD square, probability into deviation into deviation. Standard deviation is 5.59%. Return is 17.5. Let's not discuss anything on this. Next comes this side. 0.25 into this. Deviation. Return minus this number. Deviations are calculated. Probability into deviation into deviation. Okay. Both are having same standard deviation, 5.59, 5.59. Let me change the number a little bit. Okay, so standard deviation I've changed slightly. Okay, these are the numbers. Now I want to know how they are interrelated to each other. One thing I am very clear is they look to have negative correlation. When, for example, if the first scenario happens, I will have poor performance from first security, but very good performance from the second security. And when the last scenario happens, bad performance from the last security, good performance from the first security. So what we do is we do something called as probability into deviation of A, deviation of B. Probability into the deviation of the first security into deviation of the second security. Be in listen mode. You will do one problem along with me in some time. So probability, deviation of the first one, deviation of the second one, deviation of the first one and deviation of the second one. I've done the total. I get a negative total. Negative total means negative covariance. Negative total means negative covariance. Negative total indicates negative covariance. The total is called covariance. What is correlation coefficient? Is covariance divided by the two standard deviation. I have not done any rounding off, so I will not have a problem. When you do rounding off challenges and all will come. Negative covariance will lead to negative correlation. And negative correlation is the best thing. Is the best thing to happen because one does good, other one will do bad. Negative correlation of 0.99893, almost negative 1, almost negative 1. Now, I said it is good to have this combination. What is the reason for good to have this combination is listen. Assume what you did is you put 50% in this business. Okay, and 50% in this business. 50-50. 50 in one, 50 in the other. Now what is the time out? 50 into 50, I'll come. 50% and 50%. When I did this first scenario, weighted average 20%. Second scenario, weighted average 19.5%. Third scenario, weighted average 19.5%. Fourth scenario, weighted average 19.5. So I'm least bothered which scenario happens. I'm least bothered which scenario happens because put together I'll either get 20 or 19.5. Now I do the product, I'll do deviation. You learn calculation or later, let's not worry about it as of now. Probability into deviation into deviation. Standard deviation of my portfolio is 0.21% if you combine these together. If you combine these together, how to calculate and all, let's see it later. But basic concept is they are having negative correlation. They are having negative correlation. When you combine two businesses which are negatively correlated, you are in a very favorable position. You are in a very favorable position. So now we are going to the next concept, how to calculate correlation coefficient and covariance, for which I need my second format. This is called format 2. I have introduced format 1, return, probability, product, deviation, PD square. Format 1 plus format 1 is format 2. Format 1 plus add another format 1 on top of that, that becomes format 2. Most of our question will get solved under format 2. Most of our question will get solved under format 2. One problem we will do in format 2. Balance, as you know, I'll change the numbers, automatically the answers will start coming in. So what does the format says? Pull the probability outside, return product deviation PD square for first one, return product deviation PD square for the second one, probability into deviation of A into deviation of B, deviation of A into deviation of B. The total is called covariance. The total is called covariance. Once you divide by the individual standard deviations, you get correlation coefficient. You get correlation coefficient. In short, covariance is equal to correlation into SD of A into SD of B when you multiply them together. When you multiply them together, you will get the covariance. This will be used somewhere later on. Any doubts till this? Now, some question will say, find out a covariance between security A and security A. What? Find a covariance between my security and my security itself. There is a question which came in exam like this. Covariance between security A and security A, which is nothing but variance of security A, which is technically nothing but variance of security A. Covariance can also be calculated using beta. I'll give the logic of this later on, but the formula is beta of A into beta of B into variance of market. Covariance AB is equal to beta of A into beta of B into variance of market. The logic of this will flow when I go to beta calculation. When I go to beta calculation. Now, all these examples are for your understanding. You can do them. I'll do one question where I'm using this entire 10 columnar format, where I'm doing the 10 columnar format. Let's move. Go through question 3. Okay, nothing much for you to see in the question, right? Probability, 4 columns. What are the two security names? Security A with 4 subcolumns. Security B with 4 subcolumns. I don't expect you to even remember the format, but understand the logic. We are just adding format 1 plus another format 1. Format 1 plus another format 1. I can add a column called year may not serve much purpose, but if I want, I can add that column. What is the return of A? 10, 16. One important thing is, if it's 10, 16, you can change the order if you want. But where you're writing 10, for security B, you have to write 12. For security B, you have to write 12. For example, they give a table saying 2006, 2007, 10, 16. After some time, they say 2007, 2006, another security. So you will have to ensure that the order is proper. 2006 in the same row, 2007 in the same row. So what is the other one for? 12. Why the order is critical? Because that is going to impact covariance. That is going to impact covariance. It will not impact standard deviation at all. What is the probability? Is it given in the question? Equal 0.5, 0.5. Do that return probability product deviation PD square. So you're repeating that calculation for two securities. I'll be back in a minute. You keep doing it. Five, 8 adds up to 13. Deviation probability into deviation into deviation. The last one is an extra column called probability into the deviation of the first security into deviation of the second security, which can give negative numbers, can also give positive numbers. You will have to be a little cautious there. So probability into deviation into deviation. Any doubts in this? Can we proceed? What's the first requirement of the question? Return of portfolio is equal to, how much is the return of A? 13 into what is the weight of A? Return of B, weight of B. Close this. Return of portfolio is the weighted average of the individual returns. How much? Clear? What's the next requirement? Standard deviation of A, square root of 9 equal to 3%. Standard deviation of B, square root of 9 equal to 3%. A and B square root you have taken 3%. Any doubts? What's the next requirement? Covariance is equal to, now I have one challenge with covariance. I many a times don't write the unit of measure. The unit of measure for covariance is double percentage. It is double percentage. Variance also unit of measure is double percentage, because you're squaring the percentage into percentage. You're squaring the percentage into percentage. We leave the covariance as 9 and leave it there. Standard deviation is single percentage. Variance is technically double percentage. Variance is technically double percentage. We many times don't write anything. Covariance is 9. What's the next requirement? Correlation coefficient. Correlation is equal to CORAB is equal to covariance AB sigma A sigma B 9 3 into 3. This is called perfect positive correlation. Perfect positive correlation doesn't really help. Nothing much is going to be there. You cannot do anything in this company. No reduction in risk will be there. Perfect positive correlation. This is perfect positive correlation. Any doubts on this? What's the last thing? Okay. Now I'll explain the formula for standard deviation of portfolio. Very simple formula. There are two approaches. One is called Markowitz approach and Sharpe approach. I'll discuss Sharpe later. Formula is, if you have two security, formula is A plus B square. And if you have three security, it's A plus B plus C the whole square. So formula is A square plus B square plus 2AB. A square plus B square plus 2AB. If you have three securities, A plus B plus C the whole square. Now what is A square is sigma A WA square, that is standard deviation of A into weight of A square. What is B square is sigma B WB square, sigma B WB square. What is C square? Sigma C WC square. A is sigma A WA, B is sigma B WB, C is sigma C WC. What is 2AB is 2 sigma A WA, sigma B WB, and attach correlation AB. Attach correlation AB. Attach correlation AB. That correlation can make this plus 2AB as a negative number also. That correlation can make this plus 2AB as a negative number also if you have negative correlation. And moment it becomes a negative number, risk automatically goes down. Risk automatically goes down. In this question, nothing is going to happen because my correlation is how much? Plus 1. Wait. Correlation AB into sigma A into sigma B is what? I told something. Covariance. Covariance.
Sir, your voice is breaking.
Your voice is breaking, sir.
Okay, just give me a minute. Okay. Okay. Let me come back.
Yes, the class is clear, sir.
Sigma A, sigma B, correlation AB, if you multiply, you get covariance AB. So few problems in the formula use covariance AB. If I am using covariance AB in the formula, I will not again multiply with sigma A, sigma B. And few places I use correlation AB where I will have to do the multiplication. When will I use this? When will I use the other one? Whichever data is directly available, let me use it readily that. In this question, both are okay because I have covariance. I also have correlation. Few question I have covariance. I have not done the correlation calculation. Please don't do it. No need to do it because you will first divide by sigma A, sigma B and then multiply with sigma A, sigma B again. So that job is not needed. If it is not available, leave it. All right, portfolio risk is equal to square root of sigma A WA square, sigma B WB square, 2 sigma A WA, sigma B WB, correlation AB. Correlation AB. What is the standard deviation of the first security? Second security. 2 into 3.4, 3.6 into 1. Final answer will be 3%. No risk reduction will happen because you do not have any positive, you do not have any correlation benefit. It was plus 1. It was plus 1. Ultimate answer will turn out to be 3%. You can do the calculation. It will ultimately turn out to be 3%. Any doubts on this? Can we proceed? So I've introduced the second format. I may use the second format continuously depending on the data in the question. Any doubts? Covariance is between one security and the other security. Portfolio variance is the overall variance of the portfolio which may comprise 1, 2, 3, 4, 5, 10 securities also. Okay, this is the concept I've already done. Let's discuss. Portfolio return is the weighted average of the individual security. Portfolio risk is not the weighted average of the individual security. This is because of correlation coefficient. Two securities, sigma A WA square, sigma B WB square, 2 sigma A, sigma B, correlation AB. Three securities, sigma A WA square, sigma B WB square, sigma C WC square, 2 sigma A, sigma B, correlation AB, sigma B, sigma C, correlation BC, sigma A, sigma C. You will have to keep attaching the correlation. We are basically using the formula of A plus B the whole square or A plus B plus C the whole square. You can even go to A plus B plus C plus D the whole square. ICI has not tested more than 3 securities, but I can keep doing this anywhere. The only challenge is as more securities increase, Markowitz fails. Why Markowitz fails is, if you want to do for 4 securities, you need correlation between A and B. You will also need correlation between A and C. You will also need correlation between A and D. You will need between B and C, B and D, C and D. So many correlations you will have to keep calculating. Practical world, still I can go ahead and calculate because Excel can give me everything. But it becomes little challenging as you do more and more securities through Markowitz. Maximum in exam is 3 securities. Let's do this now. Let's do this. SD of security A.
So your voice is breaking, sir.
Others facing an issue with the voice?
Yes,
Sir, yes, sir.
your voice is breaking.
I don't know, friends.
Sir, this formula written in this concept book to securities, there plus 2 sigma A, sigma B alone is there. Should it be sigma A, WA, sigma B, WB?
Okay, there's an error here. This is covariance. This is covariance. This is an error here. This is covariance. If it's correlation, then you have to do sigma A, WA, sigma B, WB. If it's correlation, you will have to do sigma A, WA, sigma B, WB. If it's covariance, sorry. Leave it. Just attach WA, WB here. Just attach the weight. Just attach the weight. Not covariance. Just attach the weight. There's an error in the formula. Please attach the weight there. Sigma A, WA, sigma B, WB. If I'm using covariance, WA, WB will come. Sigma A, sigma C will not come. That sigma will not come. Okay, let's look at this question. Portfolio SD is equal to, right? Portfolio SD is equal to, what is the standard deviation of first security? 10%. Guys, write along with me. 10 weight, 10 into 0.6 square plus 20 into plus 2 into 10 into 0.6 into 20 into 0.4 into 0.5. The correlation coefficient is 0.5. The correlation coefficient is 0.5. Do the calculation. %. First, let me know any doubts till this. What is the risk of the first security? Any doubts on 12.17? Risk of the first security is how much? Guys, participate. 10. Second security 20. Weighted average is 10 into 0.6 plus 20 into 0.4 is 14%. But I'm not getting 14 as the answer because of less than 1 correlation. Less than 1 correlation. In fact, 10 plus 20 can become in few questions 4%, 5% also. It can become. How it could have become if this was minus 48. If this was minus 48 instead of plus 0.5 correlation, if this was minus 0.5. If this was minus 0.5, you would have become minus 48. It would have become minus 48. And if it had become minus 48, our answer is square root of 52, which is around 7%, which is around 7. So first security 10, second security 20. Put together is 7%. Put together is 7%. This is called benefit of diversification. Second example, you do it later. Yeah, please tell me.
What is the use of finding this correlation in the practical world?
What is the use of finding correlation in
practical world? Like, why are we finding all these things?
To know whether the securities are having positive correlation or negative correlation. Negative correlation are better combination.
Okay, sir.
Portfolio standard deviation and portfolio risk is the same, sir.
Yes, correct, same. Next concept called as notion of dominance, or something called as efficient security and inefficient security. Now, what is efficient and inefficient securities? A security is said to dominate another security if this is A, this is B. 10% return and 5% risk. This will dominate the other security if 10 but risk is 6. Risk is 6. Same return but carries lower risk. So A is obviously better than B. Second situation, 8, 6. Higher return, lower risk. Higher return and lower risk. One is same return. Sorry, first one was same return with lower risk. Now you are generating more return and risk is also on the lower side. Third situation, 5, 9. Risk is same but return is on the higher side. Risk is same, return is on the higher side. So you can dominate the other security. Simple thing is there are two set of people, a conservative investor and an aggressive investor. Who is a conservative guy? A guy who wants lowest risk. Who is an aggressive investor who wants highest return? In this example, which security conservative guy will select? No, let's just look at the risk. Tell me. Risk, just look at the risk. I don't want you to look at the return.
A.
Both are same. So he is saying whatever is giving higher return, you give me that. I have no problem with both of them. Which security aggressive guy will select? 10, 5. So normally what should happen is it should be in this situation. Which security conservative guy will select? Security name A. Which one aggressive guy will select? B. If you get different answer for both the people, there is no domination. Otherwise, there will be a domination because you tell conservative, he is saying I'm indifferent. Moment he says indifferent, it means there is going to be some domination. Our aggressive guy say I am indifferent, then there is going to be domination. Or the worst situation is this 8 and 6. Conservative says A. Aggressive also says A. Conservative also says A. Aggressive also says A. Let's take an example. Between these two, tell me, is there any domination? Is A better than B or B better than A? B is better than? Okay, so A is eliminated from the scene. B is better than A. Now, B will withstand in the final portfolio. It has to fight against everyone. Between B and C, is there any domination? B and C. B and D. See, what is domination is between B and C. Conservative guy will select what? B. Aggressive guy? C. Moment you get different answer, there is no domination. B, I think, will withstand everyone. B and C, there is no domination. B and D, there is no domination. B and D, there is no domination. B and F, there is no. See, each of them, as you move forward, they are generating more return, more risk. So B will withstand this. Between C and D, is there any domination? C and E. Guys, participate. C and F, C and G, C and H. So B and C are withstanding this. Between D and E, there is a domination. Who is dominating? E is dominating D. Reason is same risk but higher. So D is eliminated. Is E able to withstand against F? E against G? E against H? So E will be there in the portfolio. Is there any domination between F and G? F is dominating G because same return, lower risk. So G is also eliminated. Between F and H, is there any domination? No. So B, C, why H is? Oh, I think the option should have had H also here. The option should have had H as well. H is able to withstand everyone. I think the solution didn't have that item. Okay. Any doubts? Okay, leave it. Okay, the inefficient ones are the other one. So which is okay, I didn't even see the question. A, D, and G. Any doubts in this? Any doubts in this? Okay. Next comes compensation for risk. Now, what is compensation for risk? Is I am invested in one portfolio. I'm invested in one portfolio. You suddenly come to me and say that why don't you invest in this portfolio? You will generate extra return. You will generate extra return. In known concept is extra return means extra risk. Extra return means extra risk. But still the return could be favorably compensating me. So some question will ask, what is the compensation you got by including this in your portfolio? Now that depends on whether I have a diversified portfolio or an undiversified portfolio. Diversified portfolio means calculate Sharpe ratio. If Sharpe is improving, your excess return per unit of risk is improving. Excess return per unit of risk is improving. If it is an undiversified portfolio, mutual funds, undiversified portfolio, calculate Sharpe ratio. And if there is an improvement in Sharpe ratio, it means your excess return as a ratio of the risk is going up. And if it's a diversified portfolio, calculate tradeoff ratio. Compensation for additional risk undertaken can be computed as Sharpe ratio, which is undiversified, or tradeoff ratio, which is diversified. Increase means Sharpe going up, indicate better returns for for the risk undertaken by the investor. Let's see an example. An investor is currently earning a return of 20% with a standard deviation of 16. Investor added additional investment which increased the return to 21 and SD has gone down to what? 15. I know it's very good. But now I want to put a number for this. Why it is very good? Return is going up, risk is going down. Return is going up, risk is going down. How do I put a number? I can put a number by calculating Sharpe ratio. If Sharpe ratio is improving, it means you have been compensated really well for the extra risk which you have taken. Compensated well for the extra risk which has been taken by the investor. Clear? Any doubts in this? Able to understand now. Next is risk-free rate. A small discussion on risk-free rate. What is risk-free rate? Is the return which is being earned by a government security or a treasury bill, because government security are considered to be risk-free rate. Now, to calculate risk-free rate, we can use a formula of current yield, which is equal to interest by current market price. You do this in bond valuation. So, interest divided by value of bond. Which is interest divided by current market price. It will say 6% treasury bill does not mean 6% is risk-free rate, because if treasury bill is 6% and it's quoting at a premium or at a discount, the return can change. So just because it is 6% treasury bill does not mean the return is 6%. It can be more, it can be less depending on how it is quoting. If the price and all is not given, 6% treasury bill means risk-free rate is 6%. Guys, please be on mute. Now, there can be a situation where they can give multiple risk-free rates. What is multiple risk-free rates is, they gave an example saying that RBI is doing an auction. When RBI did this auction, bids came from people. So, somebody bid at 4.1, somebody bid at 4.2, somebody bid at 4.3, somebody bid at 4.4. All these are examples of risk-free rate only. So, if you have multiple rates, the highest rate, okay, this is an example. RBI has closed the latest auction of 2,500 crores of 182 days bills with the lowest bid at 4.3, although there were bidders for a higher rate of 4.6. If you are going with aggressive policy, you want more returns, you will take RFS 4.6. If you go with a conservative, you will take RFS 4.3. And you want to take a balanced approach, take both. Some questions, when you read the data, somewhere there will be a data called as beta of 0. There will be data of beta of 0. They will give security A, security B, security C, security D. A lot of data will be given, and somewhere beta will be 0 time. Wherever that beta is 0 time, that is the risk-free rate security. Beta of 0 indicates no risk. Risk premium of market. What is risk premium of market? Is the difference between RM and RF. Normal situation, RM has to be more than RF. RM has to be more than RF. We will see one or two questions like what happened when we did your Sharpe and Trainor, where we saw negative values for Sharpe and Trainor. There was one problem where RM minus RF was negative. That is, RM is 8, RF is 10. RM is 8 and RF is at 10. That's a rare possibility, but a question can give that also. So your risk premium of market can technically turn out to be negative. It can turn out to be negative. Extremely rare scenario, but yeah, possible. Now comes the beta calculation. So most important discussion. Beta basically measures how does my security move in relation to market. What standard deviation measures and what beta measure? Standard deviation measures how much are you deviating from the average. If you deviate upwards, standard deviation is there. If you deviate downwards, standard deviation is there. So going up, going down will lead to standard deviation, which is called total risk. But beta, market is going up. You are also going up with the market. Market is going down. You are also going down with the market. That relationship is getting measured through beta. If market goes up by 10%, I go up by 10, more, less. Am I moving in the same direction of the market? Market is going up. Day before yesterday, markets crashed big time. So when markets crashed, most of the companies were down. So that is moving in line with the market. That is positive beta. You are moving in line with the market. But there's a possibility you may move away from the market. Market is going up and you are going down. So that is a negative beta. If your movement is more or less similar to market movement, 1 beta. Because market has a beta of 1. 1 means normal risk. If market goes up by 5%, you go up by 20%, or goes down by 5, you go down by 20. That is technically called as more than 1 beta. That's technically called more than 1 beta. Now write this part alone. It is there, but still I would want to write it like this. Beta split into 2. Without probability, with probability, without probability, with probability. Formula 1, Formula 2, Formula 3. If it's with probability, I'll be using Formula 2 or Formula 3. And without probability, I'll be using Formula 1. Put arrow mark down. Use format 2. Use format 2. What is format 2? Format 1 had 5 columns. Format 2 has 10 columns. Format 2 has 10 columns. The only difference is probability, security A, return product deviation PD square, and not security B, market. Security market. Security market. That is the link you have to do. Return product deviation and PD square, and probability into deviation of security into deviation of market. What is the formula? Now write the formula. Standard deviation of security by standard deviation of market into correlation SM. Into correlation SM. I'll give the logic of the formula also. It's there in the theory part, but this area alone I want you to write. Sigma S by sigma M into correlation SM. Now what we are saying is, my security standard deviation 20%. Market standard deviation 15%. So one thing, my security looks more risky. My security looks more risky because I am at 20. Market is at only 15. But second, also check, are we correlated with the market or not? We can have positive correlation. We can have negative correlation. We can have zero correlation. Zero correlation will lead to 0 beta. Zero correlation will lead to 0 beta. So example 20, 15. This does not mean I'll have a beta of more than 1 time. This does not mean, I can say it is risky. I can say it's risky. But beta for me with the market is only 0.4. That is, along with market, my relationship is only 0.4. What's the beta you get? 0.57 something. So first formula is, how is our risk related to the market and its correlation. What is the formula for correlation we said? Covariance SM divided by sigma S, sigma M. Sigma S got cancelled. So second formula, that is the third formula. Covariance of security and market divided by variance of market. Covariance of security and market divided by variance of market. Covariance of security market divided by variance of market. Divided by variance of market. The real formula is formula 2 only, okay? Formula 3 is derived from formula 2. Why are we deriving? Because many question I'll use this. Many question I will use this. Now, formula 2 and formula 3 is used when probability is there. Assuming a question does not have probability. Question does not have probability, but asks you to calculate standard deviation. Again, do formula 2 or formula 3 only. Because if you have to do standard deviation, you have to go through 10 columns. You will have to go through 10 columns. Only situation where only beta is asked. Only beta is asked. I am going to introduce the third format with 4 columns. Beta can be calculated. Just because of the time saving, I am giving you the third format. Just because of the time saving, I am giving you format 3, which will only give me beta. Don't ask me anything other than beta. No standard deviation. Some question will ask beta and standard deviation. Format 3 cannot give you that. Format 3 cannot give you that. Question did not have probability. Question did not have probability, and it is asking for only beta. And it is asking only for beta. Then you have another format with 4 columns. You'll be able to calculate beta. That basically uses something called as a regression equation, which you would have learned maybe in mathematics, but based on that only the formula comes. Now write the format this side, format 3. Format 3, x, y, xy, y square. That's all. Only 4 columns. X, y, xy, y square. I don't have anything beyond this. Only 4 columns. What is x is security return, y is market return. X is security return, y is market return. Multiply and square the market. Multiply and square the market. Now what is the formula you can write? Sigma xy. Sigma xy minus n x bar y bar. Whatever you write here, you subtract again. Minus n x bar y bar divided by sigma yy minus n y bar y bar. In the top you write xy, in the denominator you write yy. We don't write yy, we write it as y square. We write it as y square, but it's technically y into y. It's technically y into y. Sigma xy minus n x bar y bar. Sigma yy minus n y bar square we will be writing. Y bar square will be writing. Again I am repeating, only one situation where beta is asked and you don't ask me anything else. You don't ask me anything else. I can use this format. If question suddenly asks you to calculate standard deviation as well as beta, don't waste time in doing format 3, because format 3 will not give you. Format 2 can give you everything. So then why I am not using format 2? Just because of time saving part. Only because of the time saving part. If only beta is asked, rather than opening 10 columns, I can close it with 4. Assume you forgot the 4 column, you forgot the formula. Do 10 columns, same answer you're going to get. Do 10 columns, same answer you're going to get. Whether you use formula 1 or formula 2 or formula 3 or format 2 or format 3, you're going to get the same answer. You're going to get the same answer. Format 2, formula 2, formula 3 combination can be used in any question. This format 3 and F1 is only for one scenario. That's all. That scenario is beta is asked in the question, and apart from beta, they are not telling you anything else to be done. Anything. You will see later on question which will say calculate systematic risk, unsystematic risk, beta, standard deviation, security market line, characteristic line. All of this will need standard deviation. All of this will need standard deviation. Moment you tell me standard deviation is needed, I cannot use the format 3. I cannot use the format 3. Clear? Any doubts on this? Beta measures the performance of a security in relation to market. Market has beta of 1 time. Risk-free security has beta of 0 time. A security can have positive beta, negative beta. Negative beta indicates negative correlation. Sensitivity of returns to market. That is, how is the sensitivity of my returns in relation to market? In relation to market is known as beta. I'm giving you the 3 formula. Sigma xy minus n into mean of x is x bar, mean of y is y bar, divided by sigma yy. y is y square minus n y bar minus n y bar y bar. This can be used if probability information is not given in question. Okay, assume probability information is not given. You want to use formula 2 or formula 3. Assume equal probability. And proceed ahead. So our format 2 is a comprehensive format for any question. In Excel, if you allow me, I'll do format 2 only for every problem because I don't take much time. But at your end, doing 10 column vis-a-vis a 4 column, you know the time saving which can be there. It is just because of that. Okay. So formula 2, SD of security by SD of market into correlation coefficient, covariance of security and market divided by variance of market. Everything what I gave in chart is mentioned here. I feel chart could be easy to understand. That's why alone this I told you to write. Format for formula 1, return of security, return of market, xy, y square. Format 2 is to be used for formula 2 and formula 3. Clear? Any doubts till this? Okay, next some question will say, you calculate beta. Based on the beta, can you give some observation? What is observation is buy, sell, hold. Buy, sell and hold. How can I give this observation? I will use the beta, calculate RF plus beta into RM minus RF. That is called required return. Somewhere the actual return will be there. If you are generating more or less, based on that an advice can be given. Any doubts till this? Beta computation through price change. This is what I was saying, that 2 days back market went down by 4%. Somebody's security has gone down by 8%. Indirectly you can say that security is double risk of market. And if you remember, I had used this when I was doing mutual fund. We calculated the beta, market went down by 5%, our portfolio went down by 5 into the beta. So this can also be done. The below formula is not an ideal method for calculating beta, as price changes may not precisely align with market movement. Nevertheless, it is commonly employed to assess the price fluctuation of a security in relation to the overall market, extensively applied in derivatives. In derivative chapter, I'll extensively using this formula. It will say market went up by 10%. Our security has beta of 0.8. Our security went up by 8%. Market 10, ours is 8. So that relationship will be used. Beta is equal to percentage change in security divided by percentage change in market. Let's do each of the example. Correlation coefficient of security and market, SD of security, SD of market. What is beta? Now write beta is equal to sigma S, sigma M, correlation SM. Sigma S, sigma M, correlation SM. Tell me in this example, what is the standard deviation of the security? 20 market, 25 correlation. In few rare situation, I'll be writing 20 as 0.2. That is, it does make some difference. Ideally, it shouldn't make any difference, because internationally what happens in CFA, they don't get into percentages. They give everything properly in decimals and make the question. So when you give in proper decimal form and you work with decimals, you get the exact answer, same answer. But here sometimes percentage and decimal working can change your answer a little bit. I'll explain that in that question alone. Normally we'll write 20% as 20 only, but 1 or 2 question will write 20% as 0.20. In this question, it will not make any difference. If you do 0.2 by 0.25 into 0.8 or 20 by 25 into 0.8, at some places it will make a difference. How does it make a difference? I'll explain later. Any doubts on this? Let's come to this. Okay, yeah, it is going to make a difference in this example. What is the beta of Hamburg Corp Stock Limited if the covariance is 0.23? Covariance is given in decimal. And standard deviation is given in percentage. I'll not write 32%. I'll write 0.32. Which formula you want me to use here? F3. Let's just use F1, F2, F3. You'll have to tell me that F3. So which is covariance SM by variance of M, 0.23 If you write 32 into 32, you'll get a different answer. Denominator, if you write 32 into 32, you will get a different answer. So denominator, please write 0.32 into 0.32. Reason for writing it as 0.32 because my covariance is in decimal. Covariance is in decimal. How much? 0.24. And in case somebody says I want to convert this 0.23 into percentage, you have to do into 100 into 100 two times because covariance has double percentage. Covariance has double percentage, and that is where sometimes challenges come in exam, because in one exam ICI missed giving the double percentage. They applied single percentage effect. That led to some deviation. I'll explain later. Security moved up by 12%. Market has moved down by 6%. Can you tell me what is the beta? Minus 2, not 2, minus 2, because market is moving down, security is moving up, which is minus 2. This is the situation where we will use x, y, xy, y square, x, y, xy and y square, because only thing I need is beta. Let's do this example now. Market is there, company A is there. If other than beta you want anything else, please be prepared to do a 10 column format. Let's start now. I'll add a year column as well. Year, x, y, xy, y square. X basically represents, if you don't want to write xy, you please write in bracket, x is security, y is market, xy and y square. Tell me the data. Year, how many years they have given? 2007, 2008 and 2009. X is, oh sorry, 13, 11.5, 9.8, 12, 11, 9. Format 1 I did one question, format 2 I have done one question, format 3 I am doing one question. Beyond that you will not see me doing calculation most of the time. Some discussions here and there will focus on, because beyond this there's nothing there in the portfolio chapter. It is only the same thing you will keep repeating in different ways. Xy is x into y and y square is y into y. Put a total for the last two and average for these two. Second column I need average, third column I need average. Last column I need total, last to last column, and last column I need total. Any doubts on the table? Very simple. Beta is equal to sigma xy minus n x bar y bar sigma y square minus n y bar y bar. Assume you forgot the formula. You will have to go through 10 column format. What is the sigma xy? 70.7 minus 3 into 11.4333, 10.6667, 346, 3 into 10.667, 10.667. You may get some rounding of difference. I am doing without rounding off in the Excel. I'm getting the beta as 1.0357. I've not done any rounding off. I've not done any rounding off in the calculation. Any doubts on this? Any doubts on this? Can we proceed? It is 1.0836 in this answer because rounding off has been done, 2 decimals. Okay, I did without rounding off. If I apply the other two formula and use a 10 column format without rounding off, if I do, I'll get exactly the same answer which I've got here, 1.0357143, without doing any rounding off, without doing any rounding off. Clear? Any doubts on this? Can we proceed? Done. Concept of fair or equilibrium return or fair and equilibrium beta. What is this fair and equilibrium return? The terms may look a little confusing, but understand this very clearly. What is equilibrium? Fair and equilibrium is same, okay? Fair and equilibrium is same. Fair return is what you should generate. Fair return is what you should generate. Actual return is what you are generating. Fair return is what you should give. Actual is what you are giving. Fair return is computed through CAPM formula. Fair return is computed through CAPM formula. Then I have fair beta and actual beta. Actual beta is what is there in the market. What is fair beta is what should be the beta. What should be the beta. Now, those terms you may not understand. Let's see this example. This will be very clear. Security is giving 20%. Market is giving 15%. Risk-free rate is 10%. Can you tell me what is the CAPM return for this example? CAPM return for this example. 12.5. What is the security giving? 20. Security is giving 20. So the actual return is higher than the fair return. The actual return is higher than the fair return. It is a good company. It is a good company. Any doubts till this? Now understand, fair return or equilibrium return is always calculated with actual beta. Fair return or equilibrium return is always calculated with what is the actual beta of the company. Other way around, can you use the CAPM formula and just see this part of it and tell me what should be the beta? Don't see the beta itself. Don't see the beta. Use the CAPM formula and tell me what should be the beta. 2. This is called fair beta. This is called fair beta. What should be there? What should be there? What is the actual beta? 0.5. So my beta should have been 2 times, but beta is only 0.5. I carry lesser risk than what I should have carried. I carry lesser risk than what I should have carried. Or other way, I earn higher return than what I should have earned. Both approach, my answer is by the company. To cut it short, fair beta is computed with actual return. Fair beta is computed with actual return. Put the actual return in the CAPM formula. Balancing figure is fair beta. Other way round, fair return is computed with actual beta. Return, actual beta. So one side it is fair, other side it is actual. This is very, very clear. Again, I'm repeating. To summarize, fair return can be computed with actual beta. That is, use the actual beta and tell me the CAPM return. That's one approach. Second approach is use the return given in the question and use the CAPM formula and get the fair beta. Get the fair beta. Fair beta means what should have been there so that security gives 20% return. Security is giving 20% return. If you are giving 20% return, take risk of 2 times beta. Take risk of 2 times beta, but you are taking risk of only 0.5. I'm very happy with this company. I'm very happy with this company. And the other way around is you should generate 12.5. Return is easy to understand. Beta could be little difficult to understand, but to cut it short, you cannot say fair return will be calculated with fair beta. Nothing like that. Then the formula, nothing is going to be there because fair return, fair beta, no undervalued, no overvalued. Fair return, actual beta. Fair beta, actual return. That's the linkage, and that can lead to undervalued or overvalued. That can lead to undervalued or overvalued. Any doubts on this first? Any doubts on this first? Now, why are we doing this? Some question will ask, is my portfolio taking more risk than what it should take? Taking more risk than what it should take. What it should take is fair beta. What it should take is fair beta. What it is taking is actual beta. What it is taking is actual beta. What risk should I take? Fair beta. What I'm actually taking is the actual beta. I compare and then I decide. I compare and then I decide. You can read 13 and 14. I'll discuss in a minute. Please read 13 and 14. Twelve, 13, 14 summarizes a lot of things related, interrelated elements. So read 13 and 14. You are not giving me return. Why should I give money to you? You are not giving me the required return. Who is not generating? No, why will I buy the company shares? No, I'll sell it. You are saying you as a company you cannot give me the return, then why should I buy your company? Whatever it no, it is not. You are not giving me the return means, see, they keep saying that today share are overvalued, undervalued. 4 days back there was a huge fall in the mid cap portfolio and small cap portfolio. The reason is very simple. It was overvalued market. It was technically an overvalued market. Now overvalued, undervalued and all is basically your perception. You cannot say it's correctly valued. If you're generating returns for me, then only I'll be happy. Otherwise, I don't want such share. It is not correctly valued. If you are not generating return, you are undervalued or overvalued. So I'll explain again. If you are asking me to comment on my portfolio risk in relation to the market, you will see suddenly this in another 3-4 question later. Somewhere I picked it from there only. I'll compare equilibrium beta with actual beta. How do I get actual beta? Either the formula approach. That question will have a portfolio. For portfolio, you will do weighted average. How to do weighted average, you'll understand as we proceed. Okay. So I got the actual beta. What is equilibrium beta? Use the actual return and calculate the equilibrium beta. If both are same, I'm very happy. I'm taking optimum risk. I'm taking optimum risk. But unfortunately, if my actual beta is more, it is a problem for me. It is a problem for me. Why it is a problem? You are saying beta is more. If beta is more, give me more return. No, you are not generating that return. You are not generating that return and unnecessarily taking risk. Unnecessarily taking the risk. That is called actual beta more than equilibrium beta, the opposite. And based on this, I can answer this. Actual return equal to required return, actual return greater than required return, actual return lesser than required return. This answer can also be done through beta also. Can also be done through beta also, can also be done through return also. Now, why did I discuss all this? Any doubts on this first? Any doubts on these 3 points? They are powerful points, extremely important points. Any? Okay, now we go to portfolio beta. Now we are going to portfolio beta. Okay, before I go to the portfolio beta, one concept alone is pending. Okay, there's a bullish market and there is a bearish market. I think this will get used sometime later, but I'll explain this. What is bullish market is market is likely to go up. What is bearish market is market is likely to go down. When you are in a bull market, invest in high risk companies. Invest in high risk company. High risk means high return. High risk means high return. And when you are in a bearish market, invest in low risk companies. Low risk means low return. Technically, low risk means low negative return. It will turn out to be negative return. When you are in a bearish market, it will turn out to be negative return, but it's better I invest in low risk company. Where how is the risk measured? Two ways: standard deviation or beta. Standard deviation or beta. Let's take an example. Stock market is expected to be in bullish phase. Stock market is expected to be in bullish phase. You have shortlisted 5 securities from the market and want to invest in 3. You have got 5. You want to invest in how many? 3 with a minimum of 20. With a minimum of 20 in each of the security to diversify your risk. Which market it is? Which has the highest beta? Okay, first. Next highest. Second. Next highest. These 3 will form part of my portfolio. In these 3, minimum 20, let me give to rank 2 and rank 3. Balance 60% to the highest beta. Balance 60% to the highest beta. Because my objective is to do what? Maximize the beta, maximize the return. Because I'm in bull market. Assume it's bear market. Bear market. Tell me which is 60, which is 20, which is 20. 60 will be P, lowest beta. Lowest beta, 60 is to P, 20 is to C, and 20 is to K. I can change the saying that I want to do minimum 30. Then 30 for the third rank, 30 for the second rank, balance 40 for the first rank. Balance 40. Or I can say I want to do maximum 70, minimum some number. I can put any combination. But simple logic is, in a bull market, high risk companies. In a bear market, low risk companies. High risk and low risk companies. Clear? Any doubts on this? Risk can be through beta or can be through standard deviation. Beta is preferred approach. I'll explain something called as non-diversifiable, diversifiable later, not today. We'll see that later, but that is a combination. There's something called as diversifiable risk and non-diversifiable risk. Any doubts on this concept? Now we move to portfolio beta, which is again the easiest of the lot. What is portfolio beta? Is write the individual beta and put it in security, beta, weight, product, sum of product by sum of weights will give you the portfolio beta. Sum of product by sum of weights will give you the portfolio beta. I may do again one question on this. This is not a new format and all. This is not a new format. Format only 3. Only 3 formats in the chapter. This is not a new format. This is basically our weighted average. This is what you did in source, cost, weight, product, WACC. Source, cost, weight, product. Example, Messrs. Siri has a surplus amount of 3 crores and to invest has shortlisted the following equity share: S, K, P, D and C. The numbers are same as the earlier example. The numbers are same because I just wanted to explain the concept. How much is the portfolio beta if 50% is invested where? Highest beta. Which is the highest beta? 20% is invested in lowest beta. Which is the lowest beta? And balance is equally distributed. Balance is equally distributed. Security, beta, weight, product, sum of product by sum of weights. Weight is adding up to 1. Many times it may not add up to 1. Many times it may not add up to 1 because I don't make weights adding up to 1. Net sum of product by sum of weights. Any doubts on this? There are going to be changes or extra points on this. I'll explain as we proceed. Any doubts till this first? Any doubts on this? Computation of RM and RF using 2 SML equation. If expected return and beta of 2 securities are given, then we can form 2 CAPM equations. We should solve these 2 equations. We will be able to calculate market return and risk-free rate of return. If you read in this question, you know the beta of 2 companies. You know the return of the 2 companies. So we will form 2 equation. We will form 2 equation. Let's come to this question now. Return of A is equal to RF plus beta into RM minus RF. What is the return of A? Now, I'm indirectly assuming CAPM return and the actual return is same. That's my indirect assumption here, okay? That's my indirect assumption here. This 22 is basically the actual return and 22 is also the CAPM required return. That's my assumption. What is the assumption I'm indirectly making is both shares are correctly valued. Both shares are correctly valued. What is the RF? That is what we are calculating. Okay. Beta is how much? 0.86 into RM minus RF. Then second one equal to RF plus into. Now to solve this, what you need to do is don't try to do any adjustment here. Let me directly cancel the RF. Let me directly cancel the RF. And this is called RP, risk premium. This is called RP. Don't try to simplify the equation. It will take a lot of time. It will take a lot of time. This is called RP. What is RP is? Risk premium. So can you solve and tell me what is RP? (22 minus 24) and other side it's just call it as RP.
5.26.
Okay. This is the answer I've got from live online student. Now substitute this 5.26 in any equation, you will get RF. Substitute this 5.26 in any equation, you will get RF. This is the easiest way of solving rather than trying to.
17.48, sir.
Okay, how much the RM you said? Sorry.
17.48.
This is RF or RM?
RF.
17.4. Okay. And if you add 5.26, you'll get RM. If you add 5.26, you'll get RM. Clear? Any doubts on this? Simple calculation. Can we proceed? Okay. Let's see this. You have to invest 10 lakh in a stock portfolio. Your choices are stock A 280, stock B 320, stock C and risk-free asset where you'll invest the balance. Given beta 0.9, 1.2, 1.6 and overall beta should be what? Whole market is 1 time. So here I want to know how much I should invest in stock C and risk-free asset. This is basically finding out weights. For finding out weights, the best approach is to do weighted average format. Weight. An investor can work with a target beta. What is the target beta in my example? 1 time. And would want to fix the weights for achieving the target beta. This can be computed using the weighted average format. Example, I am targeting a beta of 2 times. I want to invest in A, which is 1.5, invest in B, which is 3. Tell me what is the composition. What is the composition? This is what I did today when I was doing one WACC question where cost of equity was 20, cost of debt was some 8, and I told overall is this much. You find the weights. So security, beta, weight, product, balancing figure. A is 0.667, B is 0.333. So weighted average format can help you in giving the weights. When we do questions, sometimes you will take A 1 minus A. Sometimes even without A and 1 minus A also you can do. You'll understand in this question. In this question, I don't need A and 1 minus A also. Let's come to this question now. 4 columns. Security, beta, weight, product. Just give me 1 minute. Security, beta, weight, product. What are the securities we want to invest in? Right, ABC risk free and overall. ABC risk free and overall. What's the beta of A? 0.9. B? C? Risk free is 0. Overall? 1. How much you want to invest? In this you have decided certain things. What have you decided? 282 A C and risk free is missing. Maybe I'll need W1, W2 assumption. Without that also is possible. You will understand how is it happening without that. Now this is 252. This is 384. 252 and 384. Any doubts on this? Which means this has to be 10 lakh. You can write anything you want to write here. This number will be 0. This number will be 0. So which means this is a balancing figure. This is a balancing figure. Whatever number you want to write in risk free, I don't know what number we will write, but this is balancing figure now. This is balancing figure. Sum of product has to be 10 lakh. Sum of product has to be 10 lakh. What is the balancing figure? 1.6 into something is 3,64,000. 1.6 into something is 3,64,000. What is that number? What should be that question mark so that you get a total of 10 lakh? The format has given the answer. That's all. 227,500, 272,500. I'm getting whatever is the requirement. I'm getting whatever is the requirement. Any doubts on this? I'm going to extensively use this weighted average format in portfolio as well as in derivatives chapter. Any doubts?
Sir,
Yeah.
how do we show the working in exam?
This is how you will show. How will you show means?
Like, do we need to show the calculation or directly in calculator?
That's your wish. You can show it below the table.
So that is 172,500 or 272,500?
Is it 172, 272? 172.
Yes, sir. Risk free should be 172.
Okay, 172. Yeah. The workings part of it, if you want, you can show it below the table. But net, once you are done with all this, you will have to write one thing alone. Invest 227,500 in security C and 172,500 in risk-free assets so that you get your overall beta of 1 time. Any doubts on this? Move to the concept systematic risk and unsystematic risk. Been listen more for some time. Understand this very clearly. Okay, I'll tell you to write down whether to write or not, I'll tell you later, but we listen more for some time. There are first two approaches to calculate systematic risk and unsystematic risk. One is called standard deviation approach, which is not the right approach, but few question I don't have a choice, I'll have to do SD approach. Variance approach is always the preferred approach. What is the difference between variance and standard deviation approaches? Variance squares the deviations. Variance squares the deviation. So technically, if you have to calculate standard deviation, you have to first calculate the variance and then come to standard deviation practically. For example, we did deviation in every column. I could have just added the deviation. That cannot give me standard deviation. Just adding the deviation cannot give me the standard deviation. Why? Because some will be positive, some will be negative. So variance is always the preferred approach to do a calculation, be it even SD calculation. You have to first do variance and then only come to SD. So I have a variance approach, I have a SD approach. In this first thing is called total risk. What is total risk? Is variance SD. This is broken down into systematic, unsystematic. This is balancing figure. This is balancing figure. Let's assume this is 400. This is 20. 400 and 20. 20 is the standard deviation. Variance is the 400. Now, what is systematic risk? Is formula 2 of beta calculation. Formula 2 of beta calculation. What is the formula 2 of beta calculation? Beta is equal to standard deviation of security by standard deviation of market into correlation SM. Either use this or you take this in the other side, or you take this in the other side and use this. Either use the left hand side or the right hand side. The formula is systematic risk is nothing but numerator of F2. Numerator of F2 of beta computation. Numerator of F2 of beta computation. Let me first explain what is systematic risk. Systematic risk is basically something which is going to impact everyone in the market. When COVID came in, most of the companies got negative returns. Most of the companies got negative return except for few exceptions, but 99% will give negative returns because that's an event which is going to impact everyone. Suddenly, let's assume in India, there is a huge poverty situation, huge unemployment, huge inflation. All companies will get impacted. All companies will get impacted. They are macro factors. They are macro factor. So systematic risk you cannot eliminate. By doing diversification, you invested in one company, second, third, fourth, fifth, sixth, seventh, eighth, you kept on investing in more company. Systematic risk will not go down. Systematic risk will not go down, which is measured through beta, because beta links it with the market. Beta links it with the market. What is unsystematic risk? Is risk which is specific to a company. Risk which is specific to a company. Bharadwaj Institute will get impacted because of all the factors I said, unemployment, all that. But it also gets affected by certain factors which will impact only me, not others. For example, in and around Nungambakam or in Chennai, the CA registrations have gone down. In Chennai, the CA registrations have gone down. I'll only be impacted. Everyone is not going to be. Somebody is taking classes in Bombay. He is not going to be impacted because of this factor. This is a factor which is just impacting me. How do I diversify? Keep classes in Chennai, keep classes in Bombay. That is called geographical diversification. That's an example of a geographical diversification. If Chennai does bad, or I have classes in commerce stream, I have classes in science stream also. So people were earlier focusing on commerce stream, I was doing well. Now what happened is commerce is losing its relevance and people are doing more of science. My science business does well, commerce does bad. That is called another diversification. So there are certain events which impacts only me. It's not impacting anyone else. Some problem has happened in my operations. Some problem has happened in my operation. That is called my operation or my business risk. It's not going to impact everyone in the market. So these factors are called residual risk or unsystematic risk, which how can you eliminate? My business is dependent on winter. Buy one more business which is dependent on summer. So you are insulated from the weather risk. You are insulated from the weather risk. My business is dependent on Chennai. Get into one more business which is dependent on rest of Chennai. You are insulated from the geographical risk. So like this you can keep doing. My business is dependent on only CA classes. Get into one more business which is having science stream classes. Get into something which is not related to education itself. Get into something else. So that if education is getting impacted, something else does good. So that is what is called diversification, which you can eliminate if you keep adding more and more security. Can there be something called as fully diversified portfolio? Technically speaking, no. I cannot have anything called a fully diversified portfolio. You will still have some residual risk. You will still have some residual risk. If a question tells a portfolio is fully diversified, which one problem did in exam, unsystematic risk is 0. Unsystematic risk is 0, which means total risk is equal to systematic risk. Total risk is equal to systematic risk. If you go ahead and tell that I do not carry any unsystematic risk, which is a fully diversified portfolio, So how do I calculate? Sigma S into correlation SM, put a square. This side sigma S into correlation SM, no square, or sigma M goes the other side. Sigma M goes the other side. Other formula is beta into sigma M square. This side only beta into sigma M. Most of the question I'll be using beta into sigma M in the formula. Most of the question I'll be doing, but just remember numerator of F2 of beta computation, which can be right hand side or left hand side. Let's assume you did this and you got, just give me a minute. You got 225. Okay. Square root is 15. Till this I have no problem. Square root is 15. Residual, this is 175. You take a square root, you will not get this. This is 5. You take a square root, you will not get this. 175 balance. This is balance. 20 minus 15. 400 minus 225. 400 minus 225. So SD is not the right approach. Systematic risk as per SD. Square systematic risk as per variance. Systematic risk as per variance. Square root systematic risk as per SD will work. Total risk as per variance. Square root total risk as per SD. Total risk as per SD. Take a square. But at unsystematic it will not work. But still few problems I will say phi square is equal to variance. Phi square equal to variance. That is lack of information in the question. I will discuss all that later. But the preferred approach is always variance approach. Any doubts on this? Can you tell me, just give me 1 minute. Okay, I gave you this 15, no? How did I calculate this 50? Is 20 into 0.75. 20 into 0.75. I got this number of 15. Okay, this is how the calculation was done. Now, there's another term called as coefficient of determination. I'm going to link too many things, but understand the logic clearly. Coefficient of determination is systematic risk divided by total risk. Systematic risk divided by total risk, which you can do under variance approach or under SD approach. 15 divided by 20 is how much? 0.75. 225 divided by 400. Take a square root of that. So, systematic risk by total risk is called coefficient of determination. If you do using SD approach, it's called R. If you do using variance approach, it is called R square. If you do using variance approach, it is called R square. And if you do using SD approach, it is called R. And coefficient of determination is nothing but technically correlation coefficient. Technically, it is nothing but correlation coefficient. It's nothing but correlation coefficient. Clear? Any doubts till this? Let's first quickly discuss from the concept book and then I again come back. Systematic risk is equal to numerator of F2 of beta calculation. Systematic risk is called non-diversifiable. Why it is called non-diversifiable? Because you cannot eliminate it. What does it? It cannot be eliminated by adding more and more securities. Non-diversifiable risk means risk which cannot be reduced by diversification. Unsystematic risk is a diversifiable risk which is refers to a specific company arises due to certain problems with the company. It could be business level problem or financial. Bharadwaj Institute is suffering because we took huge debt. You cannot say everyone will suffer. Everyone will suffer. So that is our financial risk. We are suffering suddenly because 10 of our faculty have quit. 10 faculty from Bharadwaj Institute suddenly quit classes. So who will get impacted? Only we are going to get impacted. Not everyone is going to get impacted because that's a factor related to us. How can you diversify? Maybe you add more and more classes like this. So if one business gets impacted, at least other businesses are doing well. So these are factors which are going to impact only us. Suddenly a war breaks out. Suddenly a war breaks out or a disease breaks out like COVID. You invest in 20 companies, all 20 will give negative returns. All 20 are going to give negative return because that risk cannot be eliminated by doing diversification. That risk cannot be eliminated by doing diversification. So beta is a measure of non-diversifiable risk. Beta is a measure of non-diversifiable risk. If you remember, I told if you have a diversified portfolio, we use beta to measure the risk. And if you have undiversified portfolio, you use standard deviation because an undiversified portfolio carries both the risk. An undiversified portfolio carries both systematic as well as unsystematic. A diversified portfolio carries only systematic risk. Beta is a measure of non-diversifiable risk, which means a diversified portfolio only carries this because it has eliminated the other one. So that is why Sharpe ratio is used for undiversified portfolio. Trainor ratio is used for diversified portfolio. How do I calculate? As I said, numerator of F2 of beta calculation. SD of security into correlation coefficient, you take it to the other side, beta into SD of market. Either left hand side or right hand side of the equation can be used. No, can be used, no, as correlation coefficient. Example, variance, keep listening. Variance of security, SD of security, beta of security into SD of market square, or SD of security into correlation SM square, other side without square. This is balancing figure. Unsystematic risk is balancing figure. An example, 20, 10 and 0.25. 20, 10 and 0.25. 20 square is 400. 20. What is systematic risk? So SD of security into correlation of security into market. 20 into 0.25. Take a square, variance approach. Without square, SD approach. Unsystematic risk, balancing figure. Unsystematic risk, balancing figure. All this you will see it later. Just give me a minute. Okay, this unsystematic risk has different names. Okay, one name they'll use in question is called specific standard deviation. What is specific standard deviation is? This standard deviation is specific to this company. This standard deviation is specific to this company. In that question, what we will do is they'll give specific standard deviation, that is unsystematic risk. I'll square and call it as variance, which is wrong. Because I told you, you cannot square the unsystematic risk standard deviation and get the variance. But I don't have any other choice in that question. One question will use the word Residual risk is balance risk. Random error. What is random error is only leftover or risk related to that. Random error would be given under SD approach. I'll square it and call it as variance. I'll square it and call it as variance. Is that right? No, but you don't have a choice, because why not, right? 15 square is not 375. 15 square is not 375. How are we going to do it? You will understand later. Let's see an example. A portfolio has been constructed with the following features: security A, B, beta is 1.5, 1.1, random error is 6, 10, weight is 0.5 and 0.5. Random error, they have used the word sigma EI. Sigma EI. Sigma EI means SD. Sigma square EI. Sigma square EI is variance. Sigma square EI is variance. So what we will do is, we will just square the 6 and say variance. We'll just square. How this is done and all later, let's not worry for the time being, but we will do 6 square and 10 square. Okay, for the time being, just understand this. I'm going to square the 6 and I'm going to square the 10. Is that right? Technically wrong. Technically wrong. How will this be worked on? I'll explain as we proceed. So as of now, I've introduced you a few things. Systematic risk is called a measure of beta. Unsystematic risk is a residual risk, or a random error, or a specific standard deviation, or a residual variance, whichever name you wanna use for unsystematic risk. It is specific to a company. It is specific to a company. I would want to eliminate it. I would want to eliminate it by doing the process of diversification. Just put this table alone in your notebook. This table alone. Again, I don't expect you to remember any formula. Just remember numerator of F2 of beta computation, left hand side, right hand side. Just be clear on that alone. There are a lot of implications related to this. As I do, I'll be able to explain them. Okay, now I'll take it forward. The portfolio risk and portfolio beta and portfolio risk are two ways of measuring the risk. So question says calculate portfolio standard deviation. Now what happened is, I had 10 securities. I had 10 securities. A plus B plus C plus D plus E plus F plus so many formula, impossible. That approach is called Markowitz approach. The approach which we do is called Markowitz approach. But anything more than 3, 4, 5, you will start struggling. You will start struggling. How do I calculate a portfolio variance when I have so many securities? Because I need so many correlation coefficient. Even in Excel also, it is a challenging thing because I need so many correlation coefficient. That is where another approach came called Sharpe approach. What he said is very simple. Your portfolio risk is equal to systematic risk plus unsystematic risk. Portfolio risk is equal to systematic risk plus unsystematic risk. So he said very simple, systematic plus unsystematic preferred variance approach. Preferred is variance approach, no SD approach. Don't add under SD approach and then give me the answer. Only under variance approach we will do. What is systematic risk? What is the formula for systematic risk you got? Beta into SD of market or standard deviation of security into correlation SM. I cannot do standard deviation of portfolio because that is what I'm trying to calculate. That is what I'm trying to calculate. So beta of portfolio into sigma m square into sigma m square. Beta is easy to do. Take a weighted average. Then what do I do for unsystematic risk? Unsystematic risk is weighted average of unsystematic risk of A, B, C, D, E, F, G, H, whichever security you have, just take their unsystematic risk. How will you calculate their unsystematic risk? Go back to the normal calculation, total risk, their less systematic risk, you get your unsystematic risk. Is it going to be very difficult? That is easier to do because I just need to analyze the security. No correlation, nothing is brought there. No correlation and all brought there. I have the beta of every security. I know the systematic risk, everything under variance approach. When you do weighted average, because it is variance approach, you have to do W square. You have to do W square because it is under variance approach. Can I do under SD approach? Ideally, no. Ideally, no, because SD approach will fail. SD approach will fail. So we will do only under variance approach, but we are going to do what? Weighted average. We are going to do weighted average of the individual unsystematic risk. So Markowitz approach uses correlation between each pair of security to compute portfolio risk. Formula for the same is provided in the section of portfolio return and portfolio risk above. Challenges, if 10 securities, you will technically ask me totally around 45 correlation coefficient you will need between A and 9 securities, between B and another 8 securities, between C and another 7 securities, D and another 6 securities, E and another 5 securities. So as the number of securities expand, let's assume you have 100 securities, you will need around thousands of correlation coefficient. So it becomes very difficult for me to go ahead with Markowitz approach. What did Sharpe say? Very simple. Systematic risk is equal to beta of portfolio into SD of market square. Unsystematic risk W1 square. W1 square into unsystematic risk. W2 square into unsystematic risk. W3 square into unsystematic risk. Take the weights and keep squaring. This is what is done in this example, but I'll discuss later. I have done something called as W1 square, W2 square. I should have shifted this example below, but that is what is presented there. So how do I do unsystematic risk? Is just get the individual unsystematic risk and keep squaring. What will happen with this? I'll add both and get the total risk. Clear? Any doubts on this? This is another approach of calculating portfolio risk, which is preferable when I have more and more securities, which is preferable. Will the both give same answer? No, both are unique approaches. They have different way of calculations. They have different way of calculation. I think in one exam question it both matched, but many question it will not match. Many question it is not going to match. The third element I talked about is coefficient of determination. What is coefficient of determination? Is technically systematic risk by unsystematic risk. Technically it is equal to correlation coefficient. Sorry, what did I say? Systematic risk by total risk. Sorry, systematic risk by total risk. If you do under SD approach, it's called R. If you do under variance approach, it's called R square. Why is this critical? Because question will give coefficient of determination, and in bracket they'll mention R or R square. Accordingly, you do your calculation. Example: coefficient of determination is 0.8. Total variance is 400. Total variance is 400. What is the unsystematic risk as per what? Variance approach. I cannot use 0.8. Let me first square it. Let me first square it, which is R square. Which is R square. 400 into the R square is the systematic risk as per variance approach. Is the systematic risk as per the variance approach. That is, I'm using interchangeability. Total risk into coefficient of determination. Total risk into the coefficient of determination is equal to systematic risk. Total risk into CD is equal to systematic risk. So I did the squaring and did this. I get 256. Balance is unsystematic risk. Balance is unsystematic risk. Any doubts on this? Investment with margin. I gave the same heading. Investment with margin of 40%. This would mean that we have borrowed money to the extent of 40% and made 140% investment in risky portfolio. Example, return of a risky portfolio is 20%. I have invested with a margin of how much? 50. So I'll earn 20 into 1.5. I'll earn 20 into 1.5. It doesn't end here. You have to pay interest of how much? 10 on 0.5. 10 on 0.5. See, now the weights will always add up to 1. What are the weights now? Is plus 1.5 and minus 0.5. Plus 1.5 and minus 0.5. What you did is you had 1 rupee. You borrowed 50 paise, invested 1 rupee 50 paise, invested 1 rupee 50 paise. And what other thing you did is on your borrowing of 50 paise, you have to pay 10. Now, what is indirectly happening here is I am borrowing at 10%, earning 20% on that. So that improves my return. That improves my return. But unfortunately, this will increase your risk also. This will increase your risk also. So the return is going up to 25%. Any doubts till this? Any doubts till this? What we are doing is we are borrowing and investing. Now coming to the risk part of it, when you borrow, the weights are 1.5 and minus 0.5. The weights are 1.5 and minus 0.5. Sigma 1 W1 square. Sigma 1 W1 square. Sigma 2 W2. For a borrowing, you cannot have a standard deviation. For a borrowing, you cannot have a standard deviation. So sigma 1 W1 square, sigma 2 W2 square is 0. Is 0. 2 W1 W2 sigma 1 sigma 2 correlation is also 0. That is also 0. So indirectly your risk is only sigma 1 W1. Your risk is only sigma 1 W1, but the problem is your W1 is more than 1. W1 is more than 1. So if you borrow and increase investment, your risk will double, triple, 4 times, 5 times, 10 times. You can do anything. You can do. What is the risk in this example? Next example, SD is 20%. If you borrow 50%, and put in a risky portfolio, your risk will become 20 into 1.5 times. 20 into 1.5. You are now saying, no, I'll borrow 100% and put 200. Put 200, risk will double. You borrow 200 rupees and invest 300, risk will become 3 times. Risk will become 3 times. Why are you doing this? To earn more return. To earn more return. To cut it short, portfolio return is equal to whatever percentage into risky portfolio into return of risky portfolio minus cost of borrowing into the proportion of borrowing. But risk is risk of risky portfolio into your proportion directly. Into your proportion directly. No minus and all there. No minus and all there. Borrowing can only increase your risk. Borrowing can only increase your risk. Can borrowing increase my return? Yes, it is increasing your return. See, 25%. It is increasing your return. But that's the other way around. Other way around is if market crashes. If market crashes, your risky portfolio will generate 2%. But you have to pay 10% interest. You have to pay 10% interest. That time you will feel the pain. That time where the pain is going to come. That is the risk element. That is the risk element. So to cut it short, again, I'm repeating. Portfolio return is equal to whatever is my investment, which can be 140%, 150, 160, 170, 180, 190 into the normal return minus cost of borrowing into the proportion of borrowing. Risk is portfolio risk into directly the weight. Portfolio risk into directly the weight. No minus and all there. No minus and all there. Why nothing is happening? Because this can only increase your risk. This can only increase your. In fact, this is not combining two security and all. So I gave formula sigma 1 W1, sigma 2 W2, sigma 3. Nothing like that. It's only sigma 1 W1. It's only sigma 1 W1. You have 1 rupee, but you're investing 2 rupee. You're having 1 rupee, but you're investing 2 rupee. How are you investing? By borrowing extra. By borrowing extra. Any doubts on this? Any doubts on this? Can we proceed? Next. Fully diversified portfolio. I'll go back to problems in 2-3 minutes. A fully diversified portfolio does not carry unsystematic risk. Does not carry unsystematic risk. So for a fully diversified portfolio, total risk is equal to systematic risk of the portfolio, which is equal to left hand side, right hand side. You can keep doing either way. There's a left side, there's a right side, and there's another formula. But it is equal to what? Only the systematic risk. It's equal to only systematic risk. In this concept, there were two problems. There were one problem where two concepts were alike tested. One concept is return due to sheer skill of portfolio manager. And second concept is return due to excess risk taken by portfolio manager. These two concepts got tested in one exam question. Let's first understand both the concept. I don't want you to know the formula. Market says if market will give you 10% return, risk-free security will give you 6% return. Risk-free security will give you 6%. This has a beta of 0. This has a beta of 1. What you did is You said you will take more risk. You said you will take more risk. So you took a risk of 1.4. Tell me how much return I should generate for 1.4. Apply the formula. RF plus beta into RM minus RF. No, no, directly no into 10. Guys, please. RF plus beta into RM minus RF. How much? 11.6. So if you don't take risk, 6%. If you take one risk, 10%. What you did is you took more risk. You took more risk. You should have generated 11.6. Now he's saying I've generated 14%. I've generated 14%. The gap between 14 and 11.6 is the return due to the sheer skill of the portfolio manager. That is his skill. That is his skill. He is saying I am doing an excellent portfolio manager is, let's assume, a mutual fund manager. He is saying I am taking extra risk. Don't worry, but I am going to generate more. So 14 minus 11.6 is my skill, technically called as alpha. Technically called as alpha. The second part is the gap between 11.6 and 10 is the return due to the extra risk taken by me. Return due to the extra risk taken by me. What is extra risk? Above 1. Above 1. So 10 till 11.6 is called return due to the extra risk taken. 11.6 to 12, 13, 14, 15, 16, 17, 18, whatever is the number is called as my ability. My ability. Example. A portfolio has a beta of 1.5. A portfolio has a beta of 1.5. Risk-free rate is 6%. Market return is 9%. How much of the portfolio return is attributable to the higher risk assumed by portfolio manager? Higher risk assumed by portfolio manager. What is the beta of the portfolio? Can you tell me what is the CAPM return? 10.5 minus 9 is the extra risk. 10.5 minus 9 is the extra risk. Why am I taking extra risk? That's my wish. I'm taking extra risk. So 10.5 minus 9 is the extra risk taken by me. Is the extra risk taken by me. Can you give me answer to this? Think properly and give me an answer to this. I don't want any mistakes here. Think and tell me. Think. Most of the MCQs will enable you to revise the entire chapter. Think and let me know. Fully diversified means what? SD of portfolio is systematic risk of portfolio. SD means systematic risk under SD approach. Under SD approach. At systematic risk level, whether you do SD approach, variance approach, I have no problem. Only the unsystematic is a problem. Only the unsystematic is a problem. What is the formula for systematic risk? Beta of portfolio into SD of market is equal to 2.625. Beta of portfolio into SD of market is equal to 2.625. Somebody says, no, I want to do variance approach. Take square of everything. I have no problem. Take square of SD also. Take square of this side also. Answer is going to remain same. Systematic risk level, I have no problem. It's the problem with only unsystematic risk. So what do you get as beta here? 2.625. In fact, the answer has variance approach, but doesn't really matter. Both are going to be same. Both are going to be same. To revise again, there are three components of return always. One is the risk-free part. Second, the gap between the risk-free and the market. And the third is the extra risk. The third is the extra risk. And on top of this is my skill. On top of this is my skill, which is sheer skill, which is technically called alpha, gap between CAPM and actual. Gap between CAPM and actual. Any doubts on this? Characteristic line CML and SML. I want to link them together in one approach. So that is why we are going to discuss all questions related to this together. Now listen. Each of this, guys, be in listen mode. What is characteristic line CML and SML is all the three can be used to calculate required return. All the three can be used to calculate required return. Characteristic line says the return of a security, should be beta into RM. Beta into RM. No concept of RF. No concept of RF. Don't even bring RF into picture. Market gives 12%, 1 beta. If you have 2 beta, 24%. 3 beta, 36%. And you may be generating something more. You may be generating something more, which is called alpha. So to put a characteristic line, I need alpha plus beta into return of market. Alpha plus beta into return of market. This characteristic line will be different for TCS, will be different for Infosys, will be different for Tata Motors. How is it going to work? I am going to write alpha of TCS. So an example of characteristic line is 2 plus 1.5 RM. 2 is my alpha, 1.5 is my beta. What is the use? Somebody will say next year market will give 12%. Okay, substitute 12 in the formula. Next year market will give 14%. Substitute 14 in the formula. Next year market will give 5%. Substitute 5 in the formula. This is only for TCS. This is only for TCS. This is not for everyone. Alpha plus beta into RM. You want for Infosys? Put 3 plus 2 RM. 3 is the alpha of Infosys. 2 is the beta of Infosys into RM. Change RM, the returns will keep changing. So alpha, how is it calculated? There are certain changes. I'll explain that later as we proceed. Okay. So this is one part. So characteristic line ignores the concept of risk-free rate. Ignores the concept of risk-free rate, or in other words, it assumes risk-free rate to be 0. If you take risk-free rate to be 0, RF plus beta into RM minus RF, can you shorten and tell me if risk-free rate is 0? Beta into RM, because RF is 0, RM minus RF, again RF became 0. So according to see the alpha which you calculated, no, there are 3 ways of calculating alpha itself. Formula is same, required return and compare with actual return.
Required breaking.
Guys, others facing an issue with voice?
Sir, your voice is breaking.
Okay,
Yes, sir.
okay, I come back. So listen. Alpha is basically how much extra are you generating. But how much should I generate depends on 3 formula. Characteristic line says how much you should generate is beta into RM. Characteristic line says how much you should generate is beta into RM. CAPM says how much you should generate is RF plus beta into RM minus RF, and there's one more approach which says what you should generate is based on standard deviation. What you should generate is based on standard deviation. I'll keep explaining one by one. Next come SML, which is nothing but your CAPM equation. RF plus beta into RM minus RF. This is for the entire industry. This is for the entire industry. You want to do it for Infosys, substitute the beta of Infosys. You want to do it for TCS, substitute the beta of TCS. Then came the capital market line. Capital market line. What did capital market line says is required return of a security is equal to RF plus beta into RM minus RF is fine. But instead of using beta, they want you to use SD. They want you to use SD. But then there is a challenge here. What is the beta of market? 1. So this formula is wrong. You have been learning this formula, but the formula was RF plus beta of security divided by beta of market. But market was 1, so never I've discussed it. The actual formula is RF plus beta of security divided by beta of market into RM minus RF. But SD of market cannot be 1. SD of market cannot be 1. So I have to use that in the denominator. It's not that it is a different formula. That is beta of security divided by beta of market. That is the actual formula. That is the actual formula. Nowhere we have been using, because beta of market is what? 1 time. Beta of market is 1 time. So the required return of a security can be calculated as RF plus beta of security by beta of market into RM minus RF, or RF plus SD of security by SD of market into RM minus RF, or beta into RM. Beta into RM. You can use either of any of the approaches. Most commonly used approach is CAPM. Most commonly used approach is CAPM, but my required return can be in different ways. Required return can be in different ways. So if a question asks fit in a characteristic line, that is only for Infosys. That is only for Infosys. To fit a characteristic line, you need alpha of Infosys, beta of Infosys. But if they're asking you to fit security market line or a capital market line, I don't want to do anything company specific. I don't want any company specific. Then what do I need? I need 2-3 elements. One, I need what is the risk-free rate and what is the return of market. Risk-free rate and return of market. For that, what can happen? The question can give you two SML equation. You solve it, you will get RF and RM balancing figure. We did in one question where we said equation number 1, this equation number 2, we cancelled. I said don't cancel and leave RM minus RF, call it as risk premium, and we calculated the RM and RF. So that approach will be done to form the SML equation, to form the SML equation. For the CML equation, you will need the SD of market. How will you calculate SD of market? Go back to the format one, return, product, deviation, return probability, product, deviation, and PD square. Along with that, if you even want SD of security, then use that also. So depending on the requirements, we will decide format 1, format 2 or format 3 and try getting it. But in SML, risk is measured through beta. In CML, capital market line, risk is measured through standard deviation. Risk is measured through standard deviation. Now go to the notes and just write this alone. Required return split into 3. CM characteristic line, SML, CML. Give the heading required return. It is required return. Okay, I'm just telling I'm telling what is required return. Characteristic line, SML, CML. Characteristic line says required return is beta into RM. That's all. Characteristic line says beta into RM. SML, I need not even discuss. You know, RF plus beta into. This is the formula for required return. This is not the characteristic line. Okay, characteristic line is alpha plus beta. Why alpha is added? Because it can generate more or it can generate less. CML is RF, standard deviation of security, standard deviation of market, into RM minus RF. Just one caution, I keep getting confused which is SML, which is CML. So that alone take care of it. That alone take care of it, because you may get a doubt. I normally get a doubt. So whenever I teach, first thing I see what is written in the book and then only I teach it. So I normally get a doubt whether I need to use for SML standard deviation or beta. That doubt is always there in my mind. So be little cautious about that alone. Okay, let's look at this. Return.
Sir, in this case, whenever beta is not given, can we use CML?
There's nothing like whenever beta is not there, we can use CML. The question has to tell, friend.
Okay.
Okay. Return of security A 12%, beta of security A 2 times, return of market 8%, risk-free rate 6%. What is the characteristic line of security A? For characteristic line, I don't need this. For characteristic line, I don't need risk-free rate. Tell me what is the required return of security A? What is the required return? So tell me what is that? Guys, please participate. What is the required return of as per characteristic line? I'm talking about as per characteristic line, which is 16%. 16%. How much is the security generating? So alpha is -4. Alpha is -4. So the equation is alpha plus beta into RM. Alpha is -4. Beta is 2 RM. Why are we forming this equation? You substitute RM and then keep getting return. You substitute RM and then keep getting return. Any doubts in this? Clear? Again repeating, when you do characteristic line, RF is not needed. RF is not needed. Alpha for characteristic line is required return compared with actual return, but required return is beta into RM. Next, SD of security A 12%, beta of security A 1.5 times, SD of market 6%, risk-free rate, return of market. Can you tell me what is the required return as per SML, as per CML? Which is capital, which is CAPM? SML. So RF plus beta into RM minus RF is how much? Okay, that is SML. Then CML. RF plus 12 by 6, 12 by 6, SD of security by SD of market, SD of security by SD of market. Again repeating, capital asset pricing model equation is not beta into RM minus RF, it's beta divided by beta of market, but we need not write that because beta of market is one time. Any doubts on this? And this is the discussion on alpha. Alpha refers to the excess or deficit return earned by a security or portfolio. This is calculated by comparing the actual return with the required return. And now required has different version. One version of a required return is CAPM, which is used for a diversified portfolio. Some question will say portfolio is fully diversified, and they give data on both CML, SML. Then which one will you use? You will have to use CAPM approach. That is SML. You will have to use the SML approach. Undiversified, you will have to use the standard deviation approach. And if they specifically say characteristic line, then do beta into RM. Now, the next theory or the next concept we have is arbitrage pricing theory. Now, what CAPM says is required return is equal to RF plus beta into RM minus RF. This becomes very simplistic in nature because we think that return is only dependent on beta. So what arbitrage pricing theory said, no, it's not only beta, you consider multiple factors. Example, GDP growth can impact my return, unemployment can impact my return, interest rates can impact my return, stock market performance can impact my return. So they said, let's not consider one factor like beta, consider multiple factor. Then what's the formula they gave? RF plus beta 1 into RM minus RF plus beta 2 into RM minus RF plus beta 3 into RM minus RF. Like this, you can keep going on. When I say beta 1, it's called factor 1. It's not technically beta 1, it is factor 1. And when I say RM minus RF, it's technically risk premium of the factor. Now, practically, this is not a preferred method itself. Reason for that is getting beta is easy, but getting to know so many factors is first a difficulty. And for every factor, how much extra should I generate? Because RM minus RF is return of market minus risk free. Here you will have every factor. For every factor, you need to know what is the risk premium or return premium. What is risk or return premium? It's how much extra you should generate for every factor. How do I identify this? I'll have to just make some random assumptions and proceed ahead. This is one formula. The second formula which ICA had given at least some time back, and in the recent exam they ended up asking this. In the November 23, in APT theory, they ended up asking the second formula. What a second formula is, start with your risk-free rate, but let's assume I'm dependent on inflation. Inflation I expected 6%, turned out to be 6%, no extra return for me because it did not deviate. Interest rates I expected to be 7%. Unfortunately, it became 8. If there's any variation in the factor, you are getting exposed to risk and your return has to increase. So second formula is change in factor into the beta of factor. There are two formulae. First formula is RF plus factor 1 into risk premium of factor 1, factor 2 into risk premium of factor 2, factor 3 into risk premium of factor 3, and you go on. And the other approach is RF plus change in factor 1 into beta of factor 1, change in factor 2 into beta of factor 2, change in factor 3 into beta of factor 3, and goes on. Assume you are attempting to estimate the equilibrium expected return for a portfolio using a two factor. Only two factors they are saying, not more. One factor is 30-year treasury bill rate. Other factor is GNP, that is the GDP growth. Assume that you have estimated the risk premium. What is risk premium? How much extra you want. For interest rate, you want 2%. This is not an ICA question. This is a question in CFA material, and they are very clearly made 0.02. They don't want this percentage confusion and all. So 0.02 is the extra return you need for this factor, and the risk premium for the GNP factor is 0.03. My portfolio is impacted to the extent of minus 1.2. Minus 1.2 will lead to negative risk premium, and it is related to the GNP factor to 0.8. So what is my return? Risk free plus factor 1 beta minus 1.2 into its percentage, factor 2 beta into its percentage, and ultimately I need 3% return. Ultimately I need 3% return. This is what he said. He is saying, the APT model is saying, consider every factor at a time and attach a risk premium. Now the difficulty is, how do I attach this risk premium? Interest rate 0.02, GNP 0.03. It becomes very subjective in nature. And that is why it is not a preferred approach in the practical world. The approach loses its relevance because of calculating some random things like this. How do I calculate a random factor like this? Next comes the next segment, optimum weights for risk reduction. Now in this, I may not do much of the question, but I'll first quickly discuss it. What is optimum weights for risk reduction? Is a portfolio combination which gives me the lowest risk. A portfolio combination which gives me the lowest risk, where I have three types of problem. Two securities, easy to do. We'll do a question. We'll discuss a question. Three securities, again easy to do. I'll do a problem. More than three securities becomes very complex in computation. I have a YouTube video. You can just go through that, but I'll explain first now broadly what we are trying to do. In two securities, when you have security A and security B, first let me individually calculate their standard deviation. Now what is the requirement is, what should be the combination of A and B together so that I have the lowest risk, No discussion on return here. The discussion is only on risk. I want a combination which gives me the lowest risk, where the logical formula is weight of first security, that is weight of security 1. Order is changed. Weight of security 1 is equal to what is the risk of the other security? In your numerator, you will use the risk of the other security. Higher the risk of the other security, more will be my weight, because that is more risky, so you put more in my security. Higher the risk of the other security, you put more in your security. Only two securities, okay? So variance of security 2 minus covariance, minus the covariance is the linkage. So the numerator we use is variance 2 minus covariance 1, 2. This is to get the weight of 1. You want the weight of the second security, variance of the first security. Again subtract minus. Can you tell me the total of these two? Total of the numerator. No, what is the total? Just add variance 1 plus variance 2 minus 2 covariance 1, 2. That is your denominator, so that both add up to one time. This plus this divided by the total of them. So that our total will add up to one time. I'll repeat again. Weight of the first security is equal to variance of the second security. More the variance of the second security, more will be my weight. Deducted by the covariance. Then second security is saying, let me also look into your variance. If your variance goes up, that other security weight will go up. Divided by, why we add both? Because I need to finally ensure that weights add up to one time. So variance of security 2 minus covariance of 1 and 2 divided by variance of security 1 plus variance of security 2 minus 2 covariance 1 and 2. Clear? Any doubts on this? Second one also I can apply a formula, or you just do 1 minus this. This is if you have two securities. Now then comes the 3 security situation. For a 3 security situation, an exam question has to first give me two portfolios which carry minimum risk. Two portfolios which carry minimum risk. So the question can say 10%, 40%, 50%. This combination gives you lowest risk. Then 25%, 45%, 30%. This combination also gives you lowest risk. Then they are saying, I want you to create a third combination. I want you to create a third. Already two combinations are there. They're saying, can you create me a third combination? What they'll do in third combination, they'll say, this is 50. You tell me these two. The first one is 50, you tell me the other two. Or the second one is 20, you tell me the other two. Or the third one is 30, you tell me the other two. So they are saying, I have given you two minimum portfolio. I want you to create the third minimum portfolio. I want you to create a third minimum portfolio. So let's take an example. Portfolio 50, 25, 25 is minimum. 50, 25, 25 is minimum. 70, 20, 10 is also minimum. 70, 20, 10 is also minimum. I now need to create a third combination. I now need to create a third combination. Using the third combination, I'll have to finally decide what should be the combination of weights. Just give me a minute. Just 1 minute. I'll come to the formula part of it in some time, but I'll give you a logical answer. I just wanted to check what was there. 50, 25, 25 is my first combination, okay? Second combination is 70, 20, 10. Let's assume you want to do 60. You want to do 60, which is in between, which is exactly in between. Now, what will happen is the weights will be exactly in between. 22.5, average of 25 and 20, average of 25 and 20. Our weights is average of 25 and 10, which is 17.5, which is 17.5. That is what the weights will turn out to be. That is what the weights will turn out to be, but I need to put an equation. For example, it's not 60. Let's assume it's 30. It is 30. From 70, when you go down to 50, the weights from 20 has gone up to 25. The weights from 20 has gone up to 25. Now, from 50, if you go down to 30, from 25, please go up further 5. From 20 to 25, 25 to 30. 20 to 25, 25 to 30. 10 to 25, 25 to 40. 10 to 25, 25 to 40, put together, it will add up one time. If it's not adding up, you have done an error somewhere. You have done an error. Let's assume from this 30, you bring it further down to 10. You bring it further down to 10. So add another 5 here. 35, add another 15. If you get somewhere in between, then proportionately increase, proportionately decrease. This is what the concept is. This is what the concept is. Either there's a proportionate increase or a proportionate decrease, where you need to look at the two ratios, Just give me a minute. In exam situation, they gave something like this. To me, this is a very simple question, but again, I'll have to form an equation. Look at weight of C. What do you see there? Same, which means it is not going to relate at all. It is going to not react at all. You change anything for A and B, C will only be 0.3. C will only be 0.3. If you increase A, decrease B. Because C will only be 0.3. C is very clear. I want 0.3. I want 0.3. You are increasing A, decrease B. You are increasing A, B decreases. You increase B, A will decrease. This is what the concept is. This is what the concept is. I need to obviously give you a formula, all that. I don't remember the formula and all, but logic is this. Logic is this part of it. So I can form any type of equation provided the weights are right. For example, see, when I give an example, maybe the weights can be wrong. So whether it fits in, not fits in, we don't know. But I'm just giving a random number: 50, 30, 20, 70, 15, 15. This is just a random number I've created. If I have written the proper minimum critical equation, when I do any rework, it will add up to 1. For example, I want to bring it down to 40. I want to bring this down to 40. Tell me what will be the weight of the second security. 37.5. Why 37.5? Because I've reduced it only by 10. I've reduced it only by 10. There, for a 20 reduction, 15 was the increase. You see, 20 reduction, 15 was the increase. So increase another 7.5. And here 5 was the increase. 5 was the increase. Increase another 2.5. Sorry. sorry, 37.5. So 40, 37.5 and 22.5 put together 100. 40, 37.5 and 22.5 put together 100. So this is technically called using interpolation. This is technically called using interpolation, and then you get the weights, and then you get the weights. For this, there is a equation, all that will happen. You need to form an equation which links the weight of security 1 and security 2. I simply said 10 increase, 20 decrease, 20 increase, 10 decrease. That has to come in a form of an equation. That has to come in a form of equation. What is the equation here? For example, 50 becoming 70, 25 has become 20. So this went up by 20, that came down by 5. Now what equation they are saying? Weight of security A is technically 1.5 minus 4 times of weight of security B. That's the reality. That's the equation. That's the equation. You substitute one number, other one you will get as balancing figure. Other one you will get as balancing figure. How do you get this? 0.5 is equal to A plus 0.25B. I'm putting an equation between these two. 50 and 25. I'm putting an equation. Weight of first security is equal to, let's call it as first security, not security A. A and B are two terms you're adding. You can say X, Y, anything. Okay. A plus 0.25 B. Then second equation, 0.7 is equal to A plus 0.2 B. This is an equation between A and B. Let's assume, no, I don't want to do between A and B. I want to do between B and C. Then 0.25 is equal to A plus 0.25 B. And 0.2 is equal to A plus 0.1 C. Again, I'm repeating, A and B is not the weights. A and B is not the weights. They are just a two coefficient. You can use the term X, Y also. Once you do this, you will get an answer to this when you solve the equation. When you solve the equation. So theoretically, the weight of first security will always be 1.5 minus 4 into the weight of second security. 1.5 minus 4 into the weight of second security. That is how the weights will be in this example. In this example, you change weight of B. For example, you say weight of B is 0.2. Equation will say 1.5 into 4 into 0.2, 0.7. You say this is 0.4. 0.4. The equation will say 1.5 minus 4 into 0.4, negative 0.1. Negative 0.1. The equation will give you this number. How would I have got negative 0.1? I would have done interpolation and got it. I would have done interpolation and got it. This is the concept of critical line for 3 security. I'll anyway form one equation and then solve it. But many a times I don't remember the formula and all. I have given you the logical explanation. I've given you the logical explanation. Best thing, if 2 securities is not even changing, then that's the answer very clear. That C will only be 0.3. This is what came in exam. But anyway, I'll form an equation and then show you. I'll form an equation. Tell me. Take the weights 50, 25. Don't call it a security A, security B. Call it a security 1, security 2. Okay. Because I'm going to use a term A and B. Or let me take B and C. Okay. Weight of security B is equal to A plus B into weight of security C. The equation is weight of first security is equal to A plus B into weight of second security. A plus B into weight of second security. Which is first, which is second, your wish. Between A and B, between B and A, between C and A, between A and C, between B and C, that's your wish. How you want to form equation. To cut it short, weight of the first security, 0.25, which is I'm talking about these two, okay, is equal to A plus 0.25 B. That's what I said. No, change the names. Please change the names. That is the first thing I said. Let's call it as security 1, security 2, security 3. A and B, you can call A and B as X and Y also if you want. A and B are just names, okay? They have nothing to do with the security. A and B has nothing to do with the security. Let me make it very clear. You see the equation. Okay, I've just done one equation, but I can keep forming any number of equation. 0.3. Weight of security A. Correct. Is equal to A plus B into weight of second security. Equation is weight of security 1 is equal to A plus B into weight of security 2. Now security 1, security 2, you want to give any name, you give it, okay? I don't want to get into the name of the security. Clear? Any doubts on this? The last part is more than 3 security, which I am not going to get into solving part of it. I have a video on that. The concept basically says, this is just a brief explanation, but anyway, not much will be useful. What they are saying is, first calculate something called as strain-or ratio. What is strain-or ratio? Is how much extra return you are generating as compared to the beta. So the format is Sharpe model. The model is called Sharpe model, but we calculate strain-or ratio and arrange the securities in the order of strain-or ratio. Why do we do strain-or? Is when we create a portfolio, our understanding is the portfolio will be diversified. Our understanding is portfolio will be diversified. So securities which are high in strain-or ratio is given preference. Securities which are low in strain-or ratio are not given the preference. So you arrange the securities in that order, do something called as a cutoff calculation, and based on the cutoff, you will finally get the answer. I'll be sharing a video. I have the video in my YouTube channel. You'll find the video. The formula I have simplified little bit in this material. In the video, you will see a little complex formula. I further simplified the formula. So you can go through the video to understand it. But this formula is very simple as compared to the earlier formula. I think I've simplified at 1 or 2 places. Okay, can you apply this and tell me? Variance of security 1 is there, security 2 is there, covariance is there. What should be the investment in security 1 to formulate a minimum risk portfolio? I've given you the formula and all, do it. Weight of security 1 is equal to variance of what? Security 2. What is the variance of security 2? Minus covariance. Minus of minus. Okay, covariance is negative there. Covariance is negative. Maybe you don't see that minus there properly, but it's negative. That minus 144.25. It's not properly done there. It's minus 144.25. I should have corrected it, but okay, that is minus 144.25. Minus of minus will become plus 144.25. First one 167.75, 126.98. Minus of minus is plus 2 into 0.25. How much? 0.4650. Once you have done this, I am done with this question. I don't want to discuss the problem which is there. That is, the question had asked these data. Individual security, how to do, you know, return, probability, return, product, deviation, PD square for security ABC, return, product, deviation, PD square for security B, and probability into deviation A into deviation B. Which are these numbers which you saw? 167, 126, 144. These are the numbers you saw, because I just wanted to test the second one. Compare the risk and return with the portfolio of equal proportion. What is the proportion to formulate a minimum risk portfolio? Proportion to formulate a minimum risk portfolio, which you have done now. So I don't want to discuss it. Clear? Any doubts on this? So our usual format will give you all this. Some question after finding the weights can ask you what is the minimum risk. Then you do sigma 1 W1 square, sigma 2 W2 square. So where W1 and W2 will not be 50-50, it will be 0.465 and 0.535. 0.465 and 0.535. In this at home, if you practice, you will see that 0.465 and 0.535 combination will bring down my risk, to 0.9%, something like that, less than 1%. It will go to less than 1%. Reason for that is they are having negative covariance. They're having negative covariance. Individually, 12% and 12%. Put together, the risk goes down to 0.9% in this example. Goes down to 0.9% because you have negative covariance. You have negative covariance. Clear? Any doubts on this? Okay, let's look at whether we are able to form the weights properly. We'll do it through equation route. Because the other example is of no use. I know 0.3, answer is going to be 0.3 only. An investor has found two portfolio which are on minimum risk, weight of A, weight of B, weight of C. He has decided to put 20% in security A. Now I need to decide what do I put in B and C. How much do I put in B and C? In order to solve this, you can form an equation between A and B or A and C. Why between A and B or A and C? Because I know the weight of A. No point in giving me the equation between B and C. B and C equation will not help me because I don't know the weight of B. So there is 50, 25, 25, 70, 20, 10. I need 20 question mark, 20 question mark, Write the equation along with me. Weight of 1 is equal to, let's call it as weight of 1, okay? Weight of 1 is equal to, don't call security A. Weight of 1 is equal to A plus, write, A plus B into weight of 2. A plus B into weight of 2. I'll form an equation between A and C. Why not A and B? Because that was the example. Earlier I had this example only. So let me form an equation between A and C. What is the weight of A? 0.5 is equal to A plus B into, what is the weight of security 2, which is the third security? 0.25. 0.7 is equal to A plus B into 0.1. You need to solve this. And tell me what is A, what is B. Solve this equation and tell me what is A, what is B. Again, I am repeating, A and B has nothing to do with weight of security A, security B. If you are getting confused, name them as X and Y. I formed an equation between A and C. Solve them, get me the answer to A and B.
So B is -4 and A is 1.5.
Okay. You can go on mute. Thanks. No, this will not work. This is wrong, I think. This was between A and B. Please solve it. This is wrong, I think. Solve the equation. I have taken equation between A and C. Again, I am repeating, I have not done A and B. There's a purpose to not do A and B because A and B was already there in example. Okay, I think you guys will keep getting confused. Call it as X and Y. X plus Y W2. I have been telling this, but again, I think confusion is not ending. Call it as X plus Y W2. X plus Y W2. W1 is equal to X plus Y W2. If I solve, I think this will get cancelled. 0.2 is equal to 0.15b. 0.2 is equal to minus 0.2. Minus 0.2 is equal to 1.5b. What is the b you get? B is equal to minus 1.333. B is equal to minus 1.333. Or y is equal to minus 1.333. X is equal to point A plus B, sorry, 0.5 is equal to X plus minus 1.333 into 0.25 goes to the other side. I get 0.8333. So the equation is weight of first security is equal to 0.8333 minus 1.5 minus 1.3333 into the weight of security C. That's the equation you want to check. You can check at these two places whether it's happening or not. Whether it's happening or not. Any doubts on this? So my equation is weight of security 1 is equal to 0.8333 minus 1.333 into weight of security C. How much is the investment you want to do in A? So 0.2 is equal to 0.8333 minus 1.333 WC. Get the answer to WC. Get the weight of security C. Point. Other one is balancing figure. The other one is balancing figure. Again, I'm repeating. I can do it through interpolation also. I can do it through interpolation also. But I would prefer you know the equation properly. If question gives you security A, B, C, please name this X and Y. If question gives you X, Y, Z, name them as A plus B. A and B has nothing to do with security A and security B. Let me again make it very, very clear to you. In this, the equation was formed between A and B, that is security A and security B. I told you to form equation between security A and security C. Any doubts on this? Clear? Can we proceed? Beta basically measures the risk of a company. Beta basically measures the risk of a company. So beta can be computed in multiple ways for a company. One way of computing beta is from the asset side route. Another way of computing beta is through liability side route. What is asset side beta route? TCS has assets of whatever number. You can categorize them as project 1 10,000 crore, project 2 20,000 crore, project 3 30,000 crore. Whatever assets they are having, you may call it as fixed assets, current assets and all, but you can say this money, Indian assets so much, UK assets so much, US assets so much. India assets has a beta of 0.5. UK assets has a beta of 0.45. Some beta you have to attach. Beta basically measures the risk of that project. Beta basically measures the risk of the project. This concept you could have applied, whether you did problems on that or not. In banking accounts, we calculate something called as risk weighted assets. Every asset has some risk weights, 100%, 120%, 25%, 50%. So like that, every asset of a company carries a beta. You do weighted average of that. That is asset, beta, weight, product. That give you asset side beta. Obviously, asset side beta has to be equal to liability side beta. Asset side beta has to be equal to liability side beta. So, in a company, just give me a minute. I have business 1, business 2, business 3. This side I have equity, debt, preference. Let's, for the time being, just consider this alone. Others are not there. You calculate the beta of this is 1. You can copy this as 1. In this side, debt carries beta. Debt also has a beta. Preference also has a beta. Equity beta can become balancing figure. Equity beta can become balancing figure. Or equity, you know the beta. Debt, you know the beta. Preference, you know the beta. Use this beta in the asset side. Business 1, you know the beta. Business 2, you know the beta. Business 3 becomes balancing figure. Business 3 becomes balancing figure. Anything can become balancing figure. Anything can become. It is not beta or added. You cannot add betas. You need to do weighted average. You need to do weighted average. How we are doing weighted average and all, we'll proceed. So asset beta weight product is one route of calculating beta. Liability beta weight product is another way of calculating beta. Both the beta has to match. Both the beta has to match. Asset beta has to be equal to liability beta. Any doubts till this? What happened? Okay, asset beta equal to liability beta. So that is one way of calculating the beta. Then comes what I ended up doing is I wanted to calculate the asset beta. I'm not getting the answer. So I went to a proxy company. I can use their beta as the beta of my company. I can use their beta as beta of my company and get some missing information. So you can keep getting any type of missing information by working with either your beta or a proxy beta. In this, When you do equity side, when you do liability side beta, one adjustment is needed. What is the adjustment? Is weight of debt is equal to not the debt. Weight of debt is not equal to the debt. Weight of debt is equal to debt into 1 minus tax rate. Debt into 1 minus tax rate. What is the logic for that? If you have borrowed 500 crores, your risk is not on 500 crores. Why it's not on 500 crores? Because APB approach said if you borrow 500 crores, tax benefit is equal to debt into tax rate. Tax benefit is equal to debt into the tax rate. So leftover is what? Debt into 1 minus the tax rate. Leftover debt into 1 minus the tax rate. For preference, you cannot do into 1 minus tax because preference doesn't carry a tax benefit. Preference doesn't carry a tax benefit. So a company may invest in multiple business. Weighted average of beta of various business will give you the company beta or asset beta. It can have multiple liabilities. It can have multiple liabilities. Weighted average of beta of the liability side. Weighted average of beta of the liability side will give you company beta or liability beta. Whenever you go to the stock market and find beta, that is not beta of the company. That is the beta of the equity shares of the company. That is the beta of the equity shares of the company. Beta of equity shares is different and beta of company is different. Beta of company is different because company not only has equity, it has debt, preference, lot of other things are there. Beta computed as per point A or point B would match. It has to match. Hence, we can say liability side beta is equal to asset side beta. What is the implication of this? Assume today you have debt equity 2080. You want to change it as equity and debt combination 50-50. Overall beta will remain same. Overall beta will remain same. You can keep playing around the debt equity and see what beta you want to see. Equity beta will change, debt beta will change. Overall has to remain same. Overall has to remain same. Just because you are borrowing more or you are borrowing less, company beta cannot change. Company beta cannot change. Now then I explained that if you borrow more, it is risky. If you borrow more, it is risky, but it is risky for the equity guys. It is risky for the equity guys. Company risk remains the same. Company risk remains the same. The equity guys will start suffering. Equity guys will start suffering. So if you borrow more, overall beta will remain same, but equity beta will increase. You'll understand when we do the calculation. When will company beta change? Company beta can logically change only based on the asset side of the balance sheet. That is, you do one random project which is very risky. Overall beta of the company will increase. Overall beta of the company will increase. Business one, which was doing really well, suddenly a competitor came into the industry. Beta of that business changed. Beta of the business that changed. So in the end, the real beta comes only from the asset side. The real beta comes only from the asset side, but you can do liability side also. You can do liability side. If you are changing the capital structure, if you're changing the capital structure, what is capital structure? Is changing the debt equity mix. What will happen is the overall beta remains same. Overall beta remains same, but you can keep seeing a changes in debt and equity. You can keep seeing changes in debt and equity. We can use asset beta to compute the equity beta. Equity beta will provide us cost of equity. Equity beta will provide us cost of equity. What does company beta provide? Cost of capital directly, but we cannot use that in exam. Reason is ICA questions have certain errors. Because of that, if you use asset beta and do RF plus beta into RM minus RF, you will directly get cost of capital. If you use equity beta, you will get cost of equity. Cost of equity, cost of debt, weighted average you do, and using asset beta you do, you should get the same answer. But in exam, you will not get it because ICA does some errors in the question. So what approach we follow? We first calculate cost of equity using equity beta. Cost of equity using equity beta, not the asset beta. Today, if you find beta of Infosys, that is the equity beta of Infosys. In the market, whatever you see is the beta of equity beta of Infosys, and Infosys TCS doesn't matter because equity beta is equal to asset beta. They do not have debt in their balance sheet. They don't have any debt in their balance sheet. But what you see in the market is only the equity beta. Equity beta can give me KE. Every place we were doing KE is equal to RF plus beta into RM minus RF. That is using equity beta. If you give me asset beta, from asset beta, I have to first get the equity beta, then calculate KE. Then calculate KE. How do we do? Using the weighted average, you'll understand as we proceed. The overall beta is constant irrespective of capital structure. As we introduce more debt, the beta of equity will change. Beta of equity will change in such a way that overall beta remains same. Overall beta remains same. Impact of taxes. If you have taxes, weight of debt will be debt into 1 minus tax rate. Then comes the proxy beta. What is proxy beta? Is beta of my proxy company. Some question will give 5 proxy companies. Please calculate asset beta of 5 proxy companies. Take a weighted average or take a simple average, and that is asset beta of your company. Proxy company can only give you asset beta. Don't take their equity beta, because equity beta has two components. One is the asset beta part. Second is equity beta can be higher than asset beta if you keep borrowing more. If you keep borrowing more, because borrowing increases their risk. Borrowing increases their risk. An equity guy has risk because of two elements. One is the asset side itself. So asset beta is 1.5. No borrowing. Equity beta is also 1.5. Equity beta is also 1.5. Start borrowing, equity beta will start going up. Equity beta will start going up. So you cannot compare equity beta of my company with any other equity beta. I cannot compare that way, because equity beta has two elements: business as well as financial. Business risk as well as financial risk. What can be compared is business to business. TCS, Infosys, Wipro. Please compare, because they are into similar business. They are into similar business. TCS suddenly has huge borrowing. TCS equity beta and Infosys equity beta cannot match. But TCS asset beta and Infosys asset beta can match, provided they are into same business, same level of risk is there. So asset beta of a company can be taken as beta of proxy company. That asset beta of the proxy can be calculated from the asset side, can also be calculated from the liability side. Just because you are calculating from liability side, that does not mean it is not asset beta, because I have told you asset side beta is equal to liability side beta. Only difference I am saying is asset beta is not equal to equity beta. There are three terms: asset beta, liability beta, equity beta. Practically there's nothing like liability beta. Asset beta is left hand side asset beta, right hand side is also asset beta only. When you do it through liability side also, it is called asset beta only. When you do it through asset side also, it is called asset beta only. So I may use liability side route, I may use asset side route, I may use proxy company route, whichever. In proxy company I may use an asset side route, I may use a liability side route. Whatever way you do, it is asset beta only. Equity beta is balancing figure. Equity beta is balancing figure. Now unlevered beta. What is unlevered beta? Is beta without any borrowing. Unlevered beta means beta without any. Unlevered means you do not have any borrowing. So unlevered beta is basically the beta of the asset side. Is basically the beta of the asset side, where you ignore the capital structure. Suddenly you say, I want to do 80-20. I'm saying I'm least bothered. Unlevered beta means without this debt equity mix and all, don't bring. If the question uses the word levered beta means equity beta. Some question will use the word levered beta. Levered beta means equity beta. Unlevered beta means asset beta. So unlevered beta, asset beta, overall beta. Levered beta, equity beta, stock beta. You can keep giving different names to it. Now, what is the implication of this? If you give me levered beta in a question, this came in exam in one WACC question, sorry, in one EVA question. In economic value added, I had two problems which I said you'll be able to understand. They had given the two beta in the question. In one exam, they gave asset beta. In one exam, they gave equity beta. Equity beta directly KE, KD, WACC. Asset beta was given. From asset beta, first you have to calculate equity beta, then do K is equal to RF plus beta into RM minus RF, then apply the cost of debt, and then get the WACC. Then get the WACC. Only equity beta can be used. Only equity beta can be used to calculate cost of equity. Clear? Any doubts on this? Let's see example. Affluence Incorporated is considering whether to expand, be in listen mode for the MCQ part. Then when we do problem, you'll understand it together. Expand its recreational sports division by embarking on a new project. Current capital structure consists of 75-25. Marginal tax rate is 30%. It is a publicly traded firm that specializes in recreational sports product. It has a debt to equity ratio. It has a debt to equity ratio of 1.7, beta of 0.8, and a marginal tax rate of 35%. I am Affluence Incorporated. There's a proxy company called Aspire Brands. There's a proxy company called Aspire Brands who has a debt equity ratio of 1.7 and has a beta of 0.8. Normally beta means equity beta. Normally beta means equity beta. Infosys beta, equity beta. Now they are saying using the pure play method with Aspire as the comparable form. Aspire is the comparable form. The project beta affluence should use to calculate what? Cost of equity capital. First, I'll analyze the proxy company. I'll analyze the proxy company. Proxy company, what is the debt equity mix? 1.7. Debt is 1.7. Equity is 1. In debt, you have to do into 1 minus tax rate. You have to do into 1 minus tax rate. Their tax rate is 35%. This has given me the overall beta. This has given me the overall beta, which is 0.38. This has given me the overall beta. Source beta, weight, product, debt, equity. Debt normally has 0 beta. We'll see few questions where debt also has a beta. Debt also has a beta, but debt normally has 0 beta. Equity 0.8. Don't worry about the working part of it, okay? Don't worry about the working calculation. Let's not get into it as of now. Calculation I'll do when I do the problem. So I got the overall beta of the proxy company. Same beta I will copy in my company. Same beta I'll copy in my company, and balancing figure is equity beta of my company. Balancing figure is equity beta of my company, which is 1.18. Similar thing you will do from the other side and then come to your company and then get it. We'll see problems. So for the timing, just be clear on the thought process. Okay. Last part of the chapter, which is on portfolio strategies. Quickly discuss one MCQ I'll discuss and one problem I'll discuss. And in my material, I've added one more item called as real estate valuation. I don't want to discuss any problems on that, but I'll discuss the concept around it. Real estate valuation, because ICI has used certain points there. So I've given certain formula and all. I'll explain them. You already know the approaches. Portfolio strategies, we have 3 types of strategy. One is called buy and hold policy. Second is called constant mix policy. Third is called constant proportion portfolio insurance policy. All these 3 policy, in the theory part, there is a table which says how the returns will fluctuate when in an up market and in a down market. Can come as a theory MCQ. Because some strategy does well in an up market, some strategy does well in a down market. Buy and hold is very simple. Buy, don't make any changes. Constant mix is basically you will keep changing the mix. That is, you will keep changing the investment value based on certain event. What is event? Every 1 month you want to do it. That is an event. Or every 10% increase or 10% decrease, I want to do it. Now, what constant mix does is when market goes up, you invested 50,000. Market went up. What is 50-50? Debt and equity. Your equity of 50,000 became 60. Debt remains same 50. Practically, debt can go up by maybe 1,000. Interest and all will be there. But let's ignore the interest part of it. So, originally 50,000 equity, 50,000 debt. Market went up, equity became 60,000. Debt continues 50,000, 1,10,000. You will say same mix, make it 55-55. Make it 55-55. The mix will be given in the question. Make it 55-55. What is the implication of this? When market goes up, you will have to sell your equity share. From 60,000, bring it down to 55. Next, 55-55 became 80,000, 55,000. 80,000, 55,000. Again do a mix. Again do a rebalance. Sell the equity. When market goes down, started with 50-50. It went down to 40 and 50. Your total is 90,000. Make it 45-45, which is indirectly buy. So what constant mix does is when market goes up, you will end up selling your equity portion, and when market goes down, you will end up buying your equity portion. A strategy which will do really well if market goes up, comes down, goes up, comes down, goes up. Continuously going up or continuously going down, strategy will fail. I feel constant mix is a very good strategy because market will never continuously go up or continuously go down. You will keep having this changes, up down will keep happening. So when it is going up, you will sell it. When it is going down, you will buy it, which is a good strategy. What is CPPI's opposite? CPPI says I have something called as a floor value. What is floor values? Below this, I cannot allow any loss. Let's assume you have 10 lakh rupees. Your floor value is 8 lakh only. 8 lakh. That is, my portfolio should never go below 8 lakh. My portfolio should never go below 8 lakh. How do you determine floor value? Floor value is equal to your investment minus the maximum loss in Nifty. Minus the maximum loss in Nifty. Okay, you decided the floor value. So 10 lakh is your overall value. Floor is 8 lakh. You can take risk only for 2 lakh rupees. You can take risk only for 2 lakh, but on this you can have a multiplier, saying that 2 times, 3 times, 4 times, 5 times, 6 times, 7 times, you can have a multiplier. So in this approach, investment in equity is equal to your investment value minus the floor value into the multiplier, which is normally 2 times, Now assume market went down. 10 lakh has gone down to 9 lakh 50. Earlier when it was 10 lakh, you said you will take risk of 10 minus 8 into 2. Market went down. Now you're saying 9.5. Why did it become 9.5? Because my equity value has gone down. Now you're saying 9.5 minus 8 into 2. Your risk taking ability is going down. So what will happen is, if market goes up, you will say take more risk. So when market goes up, you will invest in equity. And when market goes down, you will say take less risk and you will sell your equity. That's how CPPI will work. You'll understand when you do a problem. But in CPPI, what will happen is, when market is going up, your ability to take risk goes up. What is ability to take risk? My portfolio value minus my floor value. Into a multiplier. So my ability to take risk goes up if market is going up. My ability to take risk goes down when portfolio is going down. Unfortunately, what will happen is, if market is going up continuously or going down continuously, again this can lead to challenge. Market is continuously going up or continuously going down. This is a very good strategy. Continuously going up means today you bought, went up, further bought, went up, further bought, went up, further bought. So you'll keep making more and more money. But the problem is, goes up, goes down, goes up, goes down, it will fail. Goes up, goes down, it will fail. Because what this strategy says is, market goes up, buy more. Market further goes up, you are very happy because you bought more. You are again buying. Market further went up, you have bought more. Again you are happy. So it will keep going up. You are continuously buying equity and equity is only going up. You are very happy about it. You bought. Market went up, you bought. Market went down. When it has gone down, you are saying sell it now. You are saying it is, let us sell it now. Again went up. After going up, you are saying buy now. After going up, you are saying buy now. It went down. You are saying sell it. So you have to sell at the lower value and buy at the higher value. That will lead to unnecessary problem. But when will this work? It went up, bought, further went up, bought, further went up, bought, further went up, bought, went down, sold, further went down, sold, further went down, sold. That is a better. See, when market is crashing, I've been continuously selling, so I get protected from the downward fall. And when it is going up, I'm continuously buying. But continuous going up, continuous going down may not happen in a practical world. You will understand it more when I show it with examples. But these are the three strategy: buy and hold policy, where you need not do anything. Constant mix policy, you will have a constant mix, which can be 50-50, 60-40, 40-50, sorry, 40-60, whatever mix, where you need to do rebalancing based on an event. CPPI also, you need to do rebalancing based on an event. What is that event? Every 10 days, every 20 days, every month, every 15 days, every Monday, that could be an event. Or every 10% fall or 10% up. Every 10% fall or 10% up. Assume 10% fall did not happen. Don't do any rebalancing. 10% up did not happen. Don't do any rebalancing. You will do rebalancing only when that event happens. Clear? Any doubts on this? I'll do problems on this in some time. Then your real estate valuation, which I'm not going to do any question, but there are 4 approaches. One is value a real estate through the debit side of P&L. What is debit side of P&L? Based on your costs. Add all costs, that is the value of the asset. Or do it based on the credit side of P&L, based on the adjusted selling price. My competitor has a selling price, follow the same selling price. Third is difference between debit and credit side, which is the profit. And fourth is based on the asset side. That is, what is the value of the asset? So You can do it based on the credit side, based on the debit side, based on, okay, sorry, based on cash flow. They've given based on cash flow. The examples will be very simple. What is based on credit side? Area in square feet into, I want to value this building. At what price did you sell a nearby building? At what price did you sell a nearby building? Or area and square feet, what is the cost of construction? What is the cost of construction? Or perpetual income divided by the capitalization rate. Perpetual income divided by the capitalization rate. Or the cash flow, present value of future cash flow discounted at investors' required rate of return. You can go through the examples given here. They'll be self-explanatory. Maybe a question comes in an MC. Okay, get me this answer. If you have understood this properly, all the three, you will give me an answer to this. Buy and hold is the easiest of the lot. Two lakh. I invested 1 lakh in debt, 1 lakh in equity. Debt remains 1 lakh. When you bought equity, what was the share market value? 100. I don't want to know this 80 and all. What is the maturity? 100 is 1 lakh, 125 is 1 lakh 25. In between, I don't want to know anything. In between, I don't want to know anything. So 1 lakh 25 plus another 1 lakh, 2 lakh 25. 1 lakh 25 plus another 1 lakh. In between, what happened? I'm least bothered. Give me an answer to this. Constant mix. You have to do rebalancing and all. Please do rebalancing quickly and then give me the answer. There's a rebalancing which will be needed in constant mix. Give it a try. I want you to attempt it. It's not a very big rebalancing to be done. Please do it. I don't know. Let me check. I started with 1 lakh and 1 lakh. Market went down. It became 80, 1 lakh. Rebalancing made it 90, 90. And this 90 continues. This 90,000 into 125 by 80. Into 125 by 80. 140,625. In exam, if it comes, then you have to do a rebalancing also at this stage. Value is 230,625. Value is 230,625. Any doubts on this? Tell me the answer to this. What is the floor value? Floor value. 9 lakh. Floor value is 9 lakh. 10 lakh minus 9 lakh into 2. 10 lakh minus 9 lakh into 2. Any doubts on this? Clear? Okay. I'll revise this in 2-3 minutes. Well, I'll start in maybe 4-5 minutes. An extension of your portfolio management is an area called risk management, where I'm not going to do any question. I'm not going to do any question, but I'll just discuss 2-3 things alone, because students end up making errors there. One is, what is value at risk is a maximum fall which can happen when the worst case scenario happens in a company. When the worst case scenario happens in a company, you invest in a stock market. You invest in stock market. If the worst case scenario happens in the market, what is the maximum probable loss you can have is called value at risk. So when you do calculation for value at risk, first thing you need to know is what is the risk of your investment, which is called standard deviation, So let's assume I invested 1 lakh. Standard deviation is 1%. What a standard deviation of 1% basically mean is, on an average, the loss can be 1%, but it can be higher, it can be lower also. The loss can be higher or lower also. So 1 lakh into 1%, you can lose 1000. Then you attach a multiple. What is that multiple? There's a confidence level I have. What is confidence level is you can work with two confidence level, 95% and 99%. There is something called as a probability table like this. Z table is something there. If you read that Z table, for 95% probability, Z is 1.65. What does 95% probability mean? With 95% confidence, I tell you your loss will not go above this, which means 5% there is a chance that loss can even go above that. 5% there is a chance that loss can even go above that. Example, event like COVID came in, your VAR would have failed at that time, because that time you wouldn't have seen the loss. Your loss could have been even more than what your VAR would have indicated. 99% confidence mean your loss will not 99% exceed that level, which means there is still a 1% chance of loss exceeding the value you are calculating. So how do you calculate loss? Loss for a single day is equal to amount invested into daily standard deviation into multiple for respective confidence level. You need to remember these two numbers. 95% is 1.65, 99% is 2.33. Okay, these two numbers you need to remember. Now, most important part, standard deviation is 8, variance is 64 1 day. This is 1 day variance. Okay, 10 days variance is 640 into 10. It is right. Into 10 doing is right. Can you tell me square root of 640? What is the answer you said? That's 25.29. So standard deviation for 1 day became 25.29 for 10 days. Standard deviation for 1 day became 25.29 for 10 days, and there's no error here. This is the right thing. So standard deviation for 1 day is 8%, is not 80% for 10 days. Is not 80% for 10 days. Then how you need to do? If you want to convert 1 day to 10 days, you have to do into square root of 10. You have to do into square root of 10. Do 8 into square root of 10. First do square root of 10 and then do into 8. So standard deviation from 1 day can move to 10 days. 10 day can move to 1 day, not by dividing or multiplying with 10, by dividing or multiplying with square root of 10. By dividing or multiplying with square root of 10, and that's a place where students make mistakes. So you have to do division or multiplication with what? Square root of 10 and not normal 10. Not normal 10. So the concept says loss for a single day is fine. 10 days you want, 20 days you want, do into square root of 20. Into square root of 20. You want it for 250 days, into square root of 250. Many students calculate for 1 day, do into 10. Do into 10, which is wrong. You have to do into square root of 10. Example, suppose you hold 2 crore shares of X Limited whose standard deviation is what? 2% per day, which means probable loss is 2 crore into 2%. But that's not the VAR. That's not the VAR. VAR needs a multiple. VAR needs a multiple. So I can have a loss of 4 lakh. Daily standard deviation is 4 lakh. What is the confidence I want? 99%. 99% confidence has a multiple of 2.33. So loss for a single day is equal to 4 lakh into 2.33. Then they're asking loss for 10 days. The 252 days is of no use in this question. It can be useful in some other place, but here it's of no use. How can it be useful? They give loss for a year is so much. Loss for a single day is equal to yearly loss divided by square root of 252. Square root of 252. You have a loss for a year. You want to convert to loss for a day. To do that, you normally divide by the number of days. You divide by the number of days. Here you have to divide by the square root number of days. Square root number of days, and number of days is not 365. Number of days is 252. In my example, it's of no use. In my example, it is of no use. This is my second point. Let us assume a month consists of 20 trading days. Monthly SD and daily SD is computed as under. Monthly SD from annual, you want divided by square root of 12. From annual you want to go to month, and from month you want to go to day, divide by square root of 20. Why 20? Because only 20 days I said, only 20 days I said. So you have to do divided by square root of 20 or multiplication of square root of 20. So the most important part is conversion between monthly and annual. It is incorrect to simply multiply or divide by 12. Instead the formula requires the use of what? Square root of 12. So you will have to be cautious about that aspect. Can you give me the answer to this? 95% confidence interval, you will have to remember the Z value, okay? They may give it in the question mostly, but still better to remember only two levels. What is the daily standard deviation? Value. 10 crore into 2% is how much? 20 lakhs. Daily loss, 20 lakh into, which is how much? 20 into 1.65 is 33 lakh. 33 into what? So 10 square root I take first, into 33 I do, I get 104.36. 104.36. In exam, many students take 33 into 10 and write 330. Right? 330, which is wrong. Clear? Any doubts on this? Now do the next one. If you listen, one thing you can do, if you have standard deviation per annum, please directly calculate loss per annum. If you have standard deviation per annum in the question, calculate loss per annum and then do division multiplication. Annual standard deviation is rupees 21,000. Annual loss is how much? Annual loss. 21,000. No. 2.33, which is 21,000 into 2.33 is 48,930. If you want monthly, divide by what? Square root of 12. Divide by square root of 12 and not divide by normal 12. Not divide by normal 12. Any doubts on this? And few question will give a value at risk in the problem and tell you to calculate the amount to be invested. The amount to be invested. The VAR is there in the question, and what is needed is the amount to be invested. There are few questions in our material. You can go through them. I'll just discuss the MCQ. Acceptable loss is how much? 2,33,000. That is value at risk can be 2,33,000. Standard deviation of the security is 1.5% per day. What is the maximum acceptable investor where VAR does not exceed what? Acceptable loss. My confidence level is 99% and the investment is to be done for 9 days. That is for 9 days. My loss should not exceed 2,33,000. For 9 days, my loss should not exceed 2,33,000. Now write loss for 9 days is equal to loss for 9 days is equal to investment. What is the standard deviation given in the question? No, per day. Okay. I want SD for 9 days, please. Investment into SD for 9 days into 2.33. Tell me the standard deviation for 9 days. You have 1 day standard deviation. Give me the standard deviation for 9 days. 4.5. So 2,33,000 into investment into 4.5% into 2.33. 2,33,000 equal to investment into 4.5% into 2.33. What happened? Take it. Take it. If this is confusing, VAR for 1 day is equal to investment into daily standard deviation into 2.33. VAR for 9 days is equal to what you got into square root of 9, which is 3. That is where 1.5 into 3 came. 1.5 into 3 became 4.5. Whichever way you want to do, but ensure that you take square root properly. You take square root properly. Any doubts on this? There are few questions in your material. There is one question where some reverse working and all was a very good problem. Do see that. And one more question came in exam where they linked portfolio and this together. How did they link is? They gave data of the historical return. It's a very simple calculation. They gave data of historical returns. So they expect you to do return, probability, product, deviation, PD square and calculate standard deviation. The standard deviation was not given in the question. You know how to calculate standard deviation if I ask you in portfolio chapter. The same thing they added it here. The same thing they added it here. It is not, it becomes suddenly difficult area. You know how to calculate standard deviation. And again, the question gave the return directly. So there is nothing. Okay. In portfolio, we learned first single security. Then we learned multiple security, which is called portfolio. For a single security, first you have to calculate return. Return is equal to P1 minus P0 plus D1 divided by P0 into 100. If dividend yield is given, P1 minus P0 divided by P0 plus dividend yield. If data is given in the reverse order, change the order and then do the calculation. So first you have to calculate return. Second, you need probability. Beyond this, you don't need anything in the question. Return, probability. If you have, problem is over. Probability given, great. Not given, equal probability. Return, probability, product, deviation, PD square. This is our format 1, which will give you return. Square root of PD square will give you standard deviation, and they can give different prices, different dividend, probability for prices, probability for dividend. You can do cross multiplication. You can do all the joint probability concepts can be used. If multiple return is given, weighted average of the various possible returns, so sum of product column. Then we said, okay, individual security is fine. Let me move to multiple security, where you bring correlation coefficient and covariance. So correlation coefficient and covariance. Covariance is format 2. Return, probability is taken outside. Return, product, deviation, PD square for security A. Return, product, deviation, PD square for security B. Probability into deviation of A into deviation of B. Covariance total. Covariance divided by standard deviation of A, standard deviation of B, correlation coefficient, +1, -1 is the range. Covariance between A and A can also be called as, covariance between A and A is called variance of A, and covariance can also be calculated through beta. Beta of 1 into beta of 2 into covariance, variance of market into variance of market. Then we moved ahead and saw portfolio return and portfolio risk. Portfolio return is weighted average. Portfolio risk is not weighted average. Portfolio risk is Markowitz. A plus B the whole square, A plus B plus C the whole square, A plus B the whole square is equal to A square plus B square plus 2AB, sigma A WA square, sigma B WB square, 2 sigma A WA, sigma B WB, correlation AB. You want to use covariance, then 2 WA WB, covariance AB. You can do 3, 4, 5, any number of securities. Then comes notion of dominance. A security is dominating the other security if you generate same return, low risk, higher return, low risk, higher return, same risk. Compensation for risk. If you want any compensation for risk, if you have a diversified portfolio, calculate Traynor ratio, and if you have an undiversified portfolio, calculate Sharpe ratio. Risk-free rate. Risk-free rate is equal to interest by the value of bond. There can be an aggressive policy, there can be a conservative stance, or there can be a moderate stance. Aggressive will take the highest, moderate take the medium one, and conservatives take the lowest risk-free rate. And there can be a hidden risk-free rate, which is the question will give multiple security and one of them will have 0 beta. One of them will have 0 beta. Risk premium of market is the difference between RM and RF, where in few scenarios risk premium can be negative. Risk premium can be negative. Beta measures the performance of security in relation to the market. It can be called as volatility of returns in relation to market, sensitivity of returns in relation to market. To calculate beta, we have two situations: with probability, without probability. Without probability, X, Y, XY, Y square, format 3. Format 3. Formula is sigma xy minus n x bar y bar, sigma yy minus n y bar y bar. That is called regression equation. Formula 2 is equal to standard deviation of security by standard deviation of market into correlation of security and market, or covariance of security and market divided by variance of market. Any of the formula can be used. You can do an observation based on beta computation. That is, wherever you calculated the beta, get the required return using CAPM, compare with the actual return and give a comment for every year. Give a comment for every year. Beta computation can also be done through price change, which is not the ideal formula, but practically works many a times. Percentage change in security divided by percentage change in market. We'll be extensively using this in derivatives chapter. Bullish market is a scenario where markets are likely to do well. Invest in high beta companies. Bearish market is a situation where market is going to crash. Invest in low beta companies. Beta is a measure for your diversified portfolio. Standard deviation is a measure for undiversified portfolio. Both are measure of risk. From standard deviation, if you eliminate unsystematic risk, you get systematic risk, which is a beta, which is indirectly like beta. Indirectly like beta. Beta is a measure of non-diversifiable risk. Fair and equilibrium return and fair and equilibrium beta. What is equilibrium return? Is CAPM, RF plus actual beta into RM minus RF. Same thing you can do using the actual return. You can say RF plus fair beta into RM minus RF. If your actual return is more than your fair return, buy the security. And if your actual beta is less than the fair beta, again buy the security. Beta I want it lesser, return I want it higher. Risk of portfolio relative to market can be commented by comparing the equilibrium return with the equilibrium beta with the actual beta. Decision on purchase or sale, undervalued, overvalued, I've already discussed. Portfolio beta is the weighted average of the individual securities with amount invested being the weight. Security beta, weight, product. You can keep altering this beta if you want, and you can replace security with Nifty if that security has a beta of 1 time. You can have a target beta. If you have a target beta, put security beta, weight, product. Today we did a question where I had a target beta of 1 time. We had some small cap, large cap, and we found out the weights. Systematic risk is a measure of non-diversifiable risk, impacts everyone. Unsystematic risk is residual risk, also called as specific standard deviation, also called as random error. Systematic risk, 3 formula, right hand side, left hand side, and through your coefficient of determination. First formula is standard deviation of security into correlation of security into market. Other side is beta of security into standard deviation of market. Other side is total risk into the coefficient of determination, which is nothing but correlation coefficient. Technically, it's correlation coefficient. You can do it under variance approach. You can do it under SD approach as far as systematic risk is concerned. When it comes to unsystematic risk, only variance approach works. Only variance approach works, which is balancing figure. There are 2 ways of calculating your portfolio risk. Markowitz, which is A plus B plus C the whole square. This is also called as using the correlation, using the pair of correlation and calculating. Another one exam said using co-movements of the security with the market, which is called Sharpe, which is equal to systematic plus unsystematic. Systematic risk is equal to beta of portfolio into standard deviation of market square. Unsystematic risk is weighted average of the individual unsystematic risk with B amount invested, with W square being the assigned weights. When you want individual unsystematic risk, some question will give random error SD, square it. Some question will give specific SD, again square it, because I don't have a choice. Coefficient of determination is equal to R or R square. R means as per SD approach. R square means as per variance approach. Investment with margin of 40% means you have invested 140 rupees by putting your 100 rupees and borrowing 40 rupees. What is the return are we generating? Return is equal to return of risky portfolio into 140 minus cost of borrowing into 40. Risk is equal to directly into 140. No minus there. Fully diversified portfolio refers to a situation which does not carry any unsystematic risk. And if you do not carry any unsystematic risk, total risk is equal to systematic risk. And you want to calculate what is the return due to sheer skill of mind, which is alpha, comparing CAPM with the required return. Return due to extra risk, CAPM return for your beta minus the CAPM return for 1 beta. Characteristic line CML and SML are basically tools to calculate the required return. Characteristic line says required return is equal to beta into RM. SML or CAPM says RF plus beta of security divided by beta of market into RM minus RF. You don't divide, but that is the formula. And your capital market line says RF plus standard deviation of security divided by standard deviation of market into RM minus RF. Each the three can give you different required return. Compare with actual, and each three can give you different alpha. Each three can give you different alpha, and characteristic line is equal to alpha plus beta into RM, which is specific for a company. CML and SML is for overall. CML and SML is for overall. Alpha is equal to, okay, alpha I've already discussed. That's the difference between the required return and the actual return, which have three approaches. You can form two SML equation and find out the RF and RM. Similarly, you may find two CML equation also. You can do two CML equation and again find RF and RM. Like you form an equation for SML, you can also find an equation for CML. Arbitrage pricing theory said required return is equal to RF plus beta 1 into RM minus RF. Beta 2 into RM minus RF. When I say beta 1, factor 1 into RM minus RF. Factor 2. When I say RM minus RF, it's called risk premium of factor 1, risk premium of factor 2. And alternate approaches where they give change in factor 1 into its beta, change in factor 2 into its beta. This mix can also be used to calculate the weights, can also be used to calculate RP1 and RP2. Like you solve two equations of SML, here also you can solve equations and get the figure. Beta and leverage is said, beta can be calculated from asset side, beta can be calculated from liability side. Asset side beta is equal to liability side beta. When you do liability side beta, debt beta, you can do it as whatever given in the question, or you can calculate, or you can take it as 0, 0 is what we normally take. Weight of debt is equal to amount of debt into 1 minus tax rate. Take the proxy company data, use it as your asset beta and take the balancing figure. Take the balancing figure. Equity beta can be used to calculate cost of equity. Debt beta can be used to calculate cost of debt. Overall beta can be used to calculate cost of capital. We don't use overall beta, we don't use debt beta, we use only equity beta. Equity beta will give me cost of equity. I'll have cost of debt, do a WACC format and get the cost of capital. Equity beta is otherwise called as your levered beta. Equity beta is otherwise called as your levered beta, and asset beta is otherwise called as your unlevered beta. Why equity is called levered beta? Because equity has two risks. One is the asset side risk and also the liability side risk. We have three types of policy: buy and hold policy, constant mix policy, and constant proportion portfolio insurance policy. CPPI, constant mix, and buy and hold. Buy and hold, very simple, no changes. We had one problem where they did not tell how much to invest in equity. So there what we did is whatever is the maximum fall which was their floor value, the gap we invested in equity, balance we put it in debt. In CPI also the gap, but there is a multiplier. There is a multiplier on top of that. Constant mix, they'll give the mix. We'll have to check whether a rebalancing is needed or not. So I think you do rebalancing for both CPPI as well as this. Whenever a rebalancing is needed, add the value. After adding the value, split in that ratio. This is for constant mix. CPPI has a formula. Investment in equity is equal to portfolio value minus your floor value into 2, 3, 4, 5, whatever is the multiplier. Minimum risk situation. If you have two security, very simple. Variance of the second security minus the covariance of 1 and 2 divided by 1, 2, variance of 1, variance of 2 minus 2 covariance 1 and 2. If you have three securities, give me two portfolios. Let's call them as A, B and C. Weight of security A is equal to X plus Y into weight of security 2. Weight of security 2. Form two equations, solve them, get your X and Y value and then do it. Or try interpolation. Real estate valuation can be through P&L side, that is debit side of P&L, which is through cost side, or revenue side, or income side, or cash flow side. Just go through the problem, that will be self-explanatory. I'll end with this then.